Before we begin MarketLit, Australia's first financial influencer, Millennial and Gen Z investment conference, we would like to acknowledge the Aboriginal and Torres Strait Islander peoples as the traditional custodians of this land. We pay our respects to the elders past, present, and emerging. Before our broadcast begins, please be advised all information provided today is general in nature and does not take into consideration your objectives, financial situation, or needs. Before making any investment decision, you should always seek independent and licensed advice which takes into account your specific circumstances. Who would have thought millennials, Gen Z, and financial influencers would be so controversial? When I set out to create Australia's first investment conference focused on these emerging categories of investors, I wasn't really prepared for the response. Some immediately got it. I mean, ASX's own investor study told us last year that we've never had so many new, young, and female investors join share market investing or have intentions to. ASX and ASIC were among the first organisations to commit to presenting at MarketLit, while others were actually confused. Some bankers asked me why I would want to speak with millennials, let alone include them in an investment conference. The skepticism and doubt over financial influencers or financial content creators was even more pronounced. While I'm glad to say these views were in the minority, it was still alarming to see that we are really still in a society where there are people there who think that only certain ages or genders with certain qualifications and certain decades of experience warrant a spotlight. Really, MarketLit has decided to confront this head on and make it our mission to include as many diverse views as possible. Old and young, experienced and new investors, women and men, stocks versus cryptocurrencies, and really local and international speakers. It's important to know that this is not an investment conference providing financial advice. Rather, we asked our contributors to provide personal and professional insights into their careers, companies, or industry. And so, before we kickstart this live stream, I would like to thank each and every one of our participants joining us from near and far to participate in this Australian first event. MarketLit stands for diversity, inclusion, and empowerment. No matter what a person's background or financial position now, we encourage everyone to take control of their finances, do their own research, and get involved. We're delighted you could join us. Please contribute to the conversation, get in touch, share your thoughts, and follow your favourite contributors online. We're all part of the same community, and through supporting diverse voices, we support the whole industry to thrive. Start by outlining what role does ASIC play in the finance community?
First of all, I really want to say thank you so much for including us in this event. We really appreciate your time. So just to clarify, ASIC and our role, we are not the shoe, that's for sure, but we are Australia's corporate markets, financial services and consumer credit regulator. Now that's a little bit of a mouthful. So really at the heart of it, when we distill down what we seek to do, it's to maintain and improve the performance of the financial systems and the entities within it. And a large part of that too is promoting confident and informed participation by our consumers and investors. The other major limb of what we do is in the enforcement space. So where we see potential harm or misconduct occurring, we obviously take action there to enforce the law.
And Summer, what are ASIC's views when it comes to key legal guidelines when people are publicly sharing and consuming financial information?
In this space, it's been a really interesting time for us, particularly since the onset of COVID. We are seeing that more and more people are sharing information in our ever-growing digital world, right? So, there's challenges for us as a regulator in that, so that there's a fragmented nature when we're talking about social media and the internet. There's the scale of information that we have to monitor. There's ease of access to that information and the rapid churn rate too. So these are all considerations that make it quite a complex environment for us right now. But if I were to boil it down and keep it very simple in terms of three fundamentals that people need to be aware of, it's are we talking about people providing a financial service? And if that's the case, you do have to have, and again, a bit of a mouthful, an Australian financial services license, an AFSL, as we call it. Second of all, is there misleading or deceptive statements in that information? Really important. And thirdly, market manipulation. So we're seeing more and more what you might have heard of in terms of pump and dump activity. Sometimes it's called momentum trading. And we need to be really cognizant of that. And, you know, if there's a deliberate attempt to interfere with the fair operation of a market, then ASIC will want to look at that, investigate and potentially take action.
Okay, now Summer, the ASX last year reported a record amount of new investors on the Australian share market. What does ASIC believe are the greatest risks to new investors and how can they protect themselves?
The market dynamics are very interesting right now and ever evolving. And look, I think there are some really key risks there and I can talk through a handful of those. Probably the first one is around if we were to see market correction. So as we know, equity markets can be very much prone to volatility. So we would be concerned that maybe there would be some retail investors out there that have overextended themselves potentially and would have potentially bought shares at a high price and would see quite a significant drop in that share value should we see a market correction. And also we'd be concerned about magnified losses for investors that have maybe borrowed to buy shares or have entered into a complex structure that they're not fully understanding at the time that they've entered into it. So that there's some really significant potential there for loss and harm. We're also seeing more and more retail investors turn to social media for advice. And look, that can be okay as a means of getting some background information, but we just really want people to remember that relying on social media comes with a degree of risk. And the risk is the really important word there. So life is all about balance and judgment. So rather than putting all of your eggs into one basket, let's really consider, getting that right balance, using your judgment and thinking about particular risks like, the fact that advice on social media may not be licensed to start off with. So you might be getting information on something that is simply inaccurate. And those providing it, they might have conflicted interests in the advice, or they might have vested interests. So they might be promoting, being paid to promote a particular certain product or idea. So that's another thing to bear in mind. We're also seeing a range of products and trading strategies that are being targeted at that growing retailer base. So we've got things like copy trading, gamification of trading, and here we would encourage people to be a little bit selfish, make it all about you. Take that time to really understand what the product is, what its risk profile looks like, and what it means for then your exposure to gains and losses, and what's your risk tolerance within that. So take the time really to sort of think through those issues. And have you looked at all the costs of that particular product, and are you aware of any underlying or hidden costs that might be involved? So read the product disclosure statement. Might be probably not what people want to hear, but it's just makes sense and will get you that balance and judgment that I'm talking about there. Scams, that's another big one. They're always around. They're, if anything, on the rise, particularly in the area of crypto, and scammers looking to solicit funds in other companies' names. We're seeing a lot of those too recently. We're putting out warnings as they're popping up and doing everything that we can to make sure people are aware. But, a few quick tips there would be, and they're really common sense. So I really would advise just, again, use your good judgment and take the time to do it. But they might be as simple as thinking about the return that product is offering. If it seems high, given that we're in a low interest environment, that really could be a red flag indicator, because, the search for yield is a very real thing for people in such a low interest environment. So just be aware there. do an internet search too on the company and the entity that you're looking to deal with. You might find that the on the legitimate website, the details simply don't match what you've been given. And check the account name too. It's a really simple thing to do, but if you're depositing money, you want to make sure it's going to the right place. And again, check the legitimate entity and the fact that whether those details actually match.
My name's Anastasia Anakontakos, and I'm a National Business Development Manager here at ASX.
Anastasia, could you start by telling us what is an ETF?
It's a really good question. It stands for Exchange Traded Fund, and it offers investors a convenient and cost-effective way to get exposure to a range of asset classes and other investment strategies. As we can see from the slides here, you have a portfolio of assets all in one trade. You can gain exposure to markets that may be difficult to access if you were trying to do it on your own. As we've already said, it's cost effective and there are a range of different investment styles. So in one single trade, an investor can buy an ETF that holds all the top 200 companies listed on the ASX. So when you're watching the news and you hear the ASX 200 did this or it did that, you can buy units in the ASX 200. You can access other key asset classes such as international equities, fixed income, or you can add specific sectors to your portfolio such as property, technology stocks, or gain exposure to commodities such as gold and oil. So an ETF is an open-ended fund traded on the market, and that's what you need to know.
So why would I buy an ETF?
You don't have to be a beginner to buy an ETF. A range of different investors buy ETFs. Sophisticated investors buy ETFs, but it is a really good way to get into the market because you don't have to be a stock-specific expert. You just have to have a particular view on the market, geography, maybe a theme or a sector. And what ETFs also do, they offer you diversification. And what is that? It helps to decrease your overall risk in your portfolio per dollar invested. So the traditional ETPs, like the ones we've discussed that track the index, like ASX 200 or the ASX 300 or the S&P 500, means they're not trying to outperform the market. So by buying into one of these ETFs, you're not going to do worse than the market, but you're not going to do better than the market. You are just going to achieve market return. So for somebody that's just looking to gain exposure and they don't know which way to go, it's a great way to start off. But what ETFs also do is they generally have lower operating costs than other professionally managed funds.
And Anastasia, how many ETFs are there? And could you please perhaps give us a few examples?
Right now, there are 222 ETFs on the ASX, which is a huge number to choose from. Usual ETFs, like the ones we've discussed, track an entire market. There are some more niche ones, and they show just how unique ETFs can be. And that includes Asian markets or emerging market ETFs, healthcare ETFs, esports and video gaming ETFs, cloud computing, battery tech and lithium. So there are a wide range of strategies, geographies, sectors that you can choose from in order to get into the ETF space.
So finally, Anastasia, could you talk us through the process of actually buying an ETF?
All you basically need is an internet connection and $500. You'll have to set up an account if you don't already have one online with an online broker such as a NAB Trade, CMC Markets, Bell Direct or ComSec, just to name a few. And you can purchase in an ETF this way, the way you would a normal equity like a BHP or a Rio. If you think you might need a little bit of help finding the right investments, at ASX, we've set up a tool where you can find an advisor near you. So we've got the slide up for that right now. If you'd like to learn more about ETFs or any other listed product for that matter, you can head straight to the ASX website where we have a range of different investment tools and just general information that you can learn from.
Craig, the stock market is at record highs. House prices are climbing higher and higher. This really looks to be a boom. So are we at risk of being in a bubble, or is this just a rebound from last year's lows?
I suppose there's always risk. There's always risk that this could be just more than a rebound. It could turn into an economic boom. And when people hear the term economic boom, they're a little bit afraid of that term, because generally what happens after a boom is, so you have a bust. But we think it's merely a response to the extraordinary stimulus that we've seen, applied by central banks around the globe, as well as governments around the globe. And really, it has been a shotgun approach. You've got all sorts of stimulus, lower interest rates, assistance to people directly, assistance to businesses. We see this as more a rebound rather than anything else. But there's always the risk of policy mistakes. And that's why we've got to always be alert in these sorts of situations. Certainly, if we think about the last economic boom that we had in Australia, you'd have to go back to 1988. And that was really after the October 87 share market crash. So a very significant crash in terms of the share market. And at that time, there was concerns that the Australian economy, as well as the global economy, could go under because of the very significant crash that we saw on the share market. But what happened was a significant amount of stimulus was applied by central banks and governments, and lo and behold, the share market didn't crash at all. So continued to fall, and the economy didn't crash. What we had is actually a boom happening in terms of home prices, if what we saw is extraordinary, a period of time of conspicuous consumption, as well. So that really drove up inflation, drove up economic growth, and then we did have the situation where central banks had to come down harder on the economy and constrain growth in the economy, and we did have that recession of the 90-91 recession. So stranger things have happened, in terms of economics over time. So we can't rule out a boom bust situation, but we believe it's more likely the fact of an economic rebound from the lows. Central banks and governments would be well aware, what happened in terms of the past, and they can learn from that experience.
Craig, when economic conditions look good, higher interest rates do start to look like a possibility. Are you concerned about inflation, and what are the preconditions for rates going up?
Well, this is the preeminent concern that we have at the moment, what's happening in terms of inflation. Now, we see it as more a rebound from the lows yet again. We see it more a consequence of what's happening in terms of COVID, where it's restricting people to go out there and manufacture, work in their workplaces. And we're seeing the extraordinary rise in things like auto prices, used car prices, new car prices, because of the inability of the supply to be able to meet demand, particularly problems in terms of computer chips. And we see also the significant rise in price in terms of domestic holiday accommodation. That's because people can't travel overseas. But as the economy starts to open up, I think so what we're going to see is supply rising to meet that higher demand, and it won't be the same sort of concern. We've got to remember, before interest rates rise in Australia, there's three set preconditions. One is in terms of inflation. The Reserve Bank wants to see inflation sustainably between 2 and 3%. Inflation's at the moment at 1.1%, so it's well below where the Reserve Bank wants it. The second thing is in terms of wages. The Reserve Bank would like to see 3% growth in wages. It's sitting at 1.5% at the moment, so still a long time off in terms of wages to get up to that goal. And the other thing is in terms of the unemployment rate. The current unemployment rate is at 5.5%, where the government, as well as the Reserve Bank, would like to see unemployment. They would like to see that down to as low as 4%. So there are the three preconditions before interest rates rise. And that's why a lot of the commentators say, look, interest rates increases are a long way off. But those are the three things that we need to watch very, very carefully. We start to see those coming realised, then we know that we're drawing closer to a higher interest rates. And when the interest rates will start to rise, it will cause some volatility in terms of the share market.
Yeah, today I'd like to talk to you and your listeners about why business model disruption matters more than ever, particularly in today's environment where technology is accelerating at a faster and faster pace, and why you should be thinking about it in relation to your investment portfolio. The first thing I'd like to do is take you through different types of technology. So you'll see on the screen here, we've got a slide that shows the amount of time that it's taken for different types of technology to reach over 50 million users. And you can see at the bottom, you've got electricity, took 46 years. The humble telephone took 35. But if you go to the very top, you'll see that modern technology like the smartphone and the internet took only a mere 4 to 7 years. Facebook took 2 years. And if any of your listeners are fans of the game Angry Birds, that only took 35 days. And so what's happening is technology is accelerating at an exponential rate. And this is around us all the time, and you need to be aware of it, particularly from an investment point of view. So Lalda, I think that we all know intrinsically that things are changing. And all you've got to do is think back over the last decade. I mean, look at the way that we used to take photos. We now take them on our smartphones. Even the way that we connect with our loved ones, the ability to be able to do a video conference and a video call with people is now easier than ever. Think about the way that you don't go and line up in a taxi rank anymore, do you? You kind of push a button and order an Uber and it turns up. And then you've got the things like the way that we listen to music, the way that we watch videos. I mean, who did not binge watch last year at home? Lots and lots of series. My friends and I used to hand around boxes of DVDs to each other. We don't do that anymore. And we also found that we can now learn anything we want online at the click of a button. So these things have been happening for a little while, but they've been accelerating. So there are some parts of our lives that will never be disrupted by technology. And these are the things that make us innately human. It doesn't matter what happens with technology, we're still going to need our connection with other humans. We're still going to have a love of experiences and going out and exploring the world. We're also going to have a continuing need for healthcare. That doesn't go away, particularly as we age. Our need for self-care, I think we can all attest to doing some good self-care last year. And things like water, gas, and electricity. We still need those things in our lives. And ultimately, we still need a certain level of face-to-face learning. Those things don't get disrupted. So it's really important to find companies that can both withstand disruption, but also take advantage of it. At Magellan, what we're looking to do is to find companies that have got both attributes. What you'll see here on the screen is companies grouped looking at whether they have got a high level of disruption, and then also looking at the level of their moat. And this was a term coined by Warren Buffett. And what it talks about the fact is that your business is like your castle and you want to protect it from your competitors. And the wider your moat, the better your competitive advantage and the longer you're going to have that advantage for. The smaller your moat, the less advantage you've got for less time. So let's have a look at these companies on the screen. You'll see in the disruption side of things, there are some companies that are highly disruptive, but they can easily be taken over by their competitors. So if we look at Tesla, for an example, yes, they're a highly disruptive company, but how long is it going to take for the motor vehicle companies who've been in this game a long time to catch them up? On the other side of it, you may have companies that have got a wide moat, like the US retail banks. They've been long and around and established for a while, but they may struggle in a digital age. And then you've got those companies that sit on the outside that possess neither a disruptive capability nor a moat. Let's just look at Macy's and CBS as an example. The US strip mall is dying. Not many people are going shopping anymore because they can have that experience online and have it delivered by Amazon in a couple of hours. CBS, which is an old world media company, they're being taken over by the likes of Netflix, where we are passionate about getting our videos on demand. And so we don't need to watch television anymore. What we're looking for at Magellan is that sweet spot in the middle, those companies that possess both disruptive capabilities and also a wide moat. Just think about some companies that you use all the time. So Microsoft has 70% market share with its operating system, Windows. We do over 5.4 billion searches on Google every single day. L'Oreal has got 60% market share with its 5 top brands, which include L'Oreal, Garnier, Maybelline, and Lancome. And then also, just think about McDonald's. We all like a little cheeky burger, but McDonald's, they've got 36,000 stores across 119 countries. These companies are highly advantaged. They have both wide moats and the ability to disrupt. So people can invest in our funds either on exchange or off exchange. We have unlisted funds and also active ETFs across global equities, from our high conviction fund, the Magellan Global Fund, and our new low-cost ETFs, the MFG Core Series, which gives you access to both international, ESG, and infrastructure stocks. To find out more, please visit our website, which is magellangroup.com.au, or you're welcome to ring me and have a chat on 1800 Magellan. Thanks so much.
Thanks for having me. Raise is a micro investing app which got listed on the ASX in 2018, but we actually launched in Australia in 2016. And what I mean by a micro investing app, it means that you can be fully invested in the market for as little as $5. And so for $5, you can get exposure to equities, bonds, cash, and be fully exposed in the market. And as well as that, Raise has a lot of automated features. So you can set up savings plans, you can set up reoccurring investments, but obviously the one that we're very well known for is roundups that link spending to savings. So as you spend, money is rounded up and invested into your Raise app. And the other most important thing about Raise, I guess, is that it's a mobile first platform. So Raise is delivered over either Apple or through Android phones, or you can also get it on a website. So in the presentation today, I'll talk a little bit about what our business model is, and then I'll talk also about our ESG initiatives that are going on. Raise has a subscription-based revenue model. And so what that means is that you pay $3.50 per month and you get access to all the Raise features, and you can invest in a conservative to aggressive portfolio or into our Emerald portfolio, Sapphire portfolio. But when you go into our customer portfolios, you do actually have to pay a slightly higher revenue model, which is $4.50 a month. Raise also has a presence both in Indonesia and Malaysia, and they're still subscription-based models, but they're obviously more in line with what Indonesians and Malaysians can pay there. So Raise has, a couple of ESG initiatives that go on, and in reality, we didn't actually structure it like this. It just came out of the culture of Raise, which is driven by the employees, and we're a very millennial-based employee group. One of them is financial literacy, and we find that nearly 60% of our users, even in Australia, are using the Raise app to improve their financial literacy. But this is obviously much more important when we go into countries like Indonesia and Malaysia, where there is such a large need for improvement of financial literacy, and Raise is a way to improve these people's lifestyle. So they're just not looking at the equation of spending, but they're also looking at the equation of how they manage their wealth. And that is an important part of the equation that Raise tries to bring. And we've started off in Malaysia and Indonesia, but we're also looking to move into Thailand and Vietnam very soon. So one of the first additions to the Raise product after it came out in 2016 was the addition of the Emerald portfolio, which is an ESG portfolio, and it was driven by our customer feedback, our customer demand for an ESG portfolio in the product. It's a very light green portfolio, as we say in the ESG world, and that was driven a lot by what ETF products were available at the time. But since then, more and more, darker green ETFs have come onto the Australian market, and you can access them and build your own ESG portfolio through custom portfolio option available on the Raise app. As I mentioned, a lot of what we do is driven by what our millennial team wants to see the company do, and obviously offsetting our carbon footprint as a company has been very important to our team. And so far, we've planted, over 6,500 trees. That's about 650 tons of carbon removed from the atmosphere. And we continue to do this, and we continue to increase the number of trees that we're planting in Western Australia to reforest parts of Western Australia, and at the same time, removing carbon from the atmosphere and offsetting our carbon footprint. So offsetters allows our customers to offset their own carbon footprint. So the planting of the trees offsets the raised carbon footprint, but offsetters allows you to offset your own carbon footprint. As well as that, it also helps the local community by building up an Australian National Relief Fund. And we also have fun prizes and competitions that go around it. And it's very affordable at $3.70 a month to offset your own carbon footprint. And we've found this to be very popular with our Raise users as well. Every day I get up and I'm very driven to come to the Raise office, because seeing us expand not only into Australia, but also into Southeast Asia, improving financial literacy, teaching people about the other side of the equation of wealth creation, which is the saving side, not just the spending side, and being able to deliver a great product which is highly recognizable in the market and is very well rated by our customers who keep coming back and back to use our product, makes me very proud of what we've done and achieved at Raise over the last 5 years plus.
Brickworks can trace its history back to 1908, when our heritage business, Austral Bricks, was incorporated in Sydney. In 1962, the company was listed on the stock exchange as Brickworks Limited. Today, we have a market capitalisation of around 3.5 billion, and our company has evolved to include a diversified portfolio of attractive businesses, consisting of a 39% stake in Washington H. Soul Pattinson, an ASX 100 company with a market capitalisation of around 7.5 billion, a 50% share of an industrial property trust in partnership with the Goodman Group. This trust has gross assets worth over 2 billion and a significant development pipeline. We have a substantial building products business in Australia, comprising the country's leading brickmaker, a vertically integrated concrete products business, and a leading roof tile business. And we have a significant building products business in North America, where we are the leading brick manufacturer in the Northeast region of the United States. At the end of the first half of this financial year, the total inferred asset backing of our portfolio of assets was around $4.1 billion, after including our net debt of $479 million. On a per share basis, the asset backing equates to over $27 per share, provided solid support for our current share price. We believe the company is well positioned for long-term growth. In particular, we are investing to meet the growing demand for prime industrial property, and we will continue to support our North American business as it pursues growth opportunities. In addition, we are undertaking a major capital investment program within our Australian building products operations, which will strengthen our competitive position in key markets across the country. We have a proven track record over a long period of time. This is demonstrated through our history of value creation and dividend growth. We have maintained or increased dividends for the last 45 years. Brickworks' dividend is underpinned by the increasing rental income from the property trust and the reliable dividends from Washington H. Soul Pattinson. The company is stable and conservative, with a low gearing level, a prudent approach to capital management, and a stable board and management team. Last year, we developed our new sustainability strategy, Building for Living Towards 2025. This strategy focuses on the opportunity to make buildings and cities safe, resilient, and sustainable. It sets a clear pathway with 15 measurable targets and commitments across 3 pillars: responsible business, environment, and our people and community. During 2020, Brickworks also formed a sustainable supply chain working group, developed a modern slavery policy, and a supplier code of conduct. We are achieving pleasing progress across many aspects of sustainability. For example, we have achieved a reduction in carbon emissions of 36% since 2006. This is supported by capital investments into modern, fuel-efficient production processes, as well as product redesign, use of recycled material and onboard fuels, and firing our kilns with green fuels such as landfill gas. It is important to note that bricks are a sustainable product made from clay and shale that is naturally abundant. Furthermore, recycled clay makes up 20 to 30% of some of our bricks. And we are proud to offer Australia's only fully certified carbon neutral brick range. Brickworks is also active in the community and has a long-standing partnership with the Children's Cancer Institute. having made direct and indirect contributions of over $4 million since 2002. From our beginnings in Sydney in 1908, Brickworks has grown into a multinational company with a significant portfolio of diversified assets, offering attractive investment and growth opportunities into the future. And that's what excites me and the team here at Brickworks.
John, could you start by telling me, why is investing in the share market an attractive prospect for growing and preserving wealth? And what's your strategy for growing wealth?
The way to build wealth is twofold. You can either buy property or buy shares. And we all know that property is out of the reach of most ordinary young people. So you have to fall back on what's the best alternative. And that, of course, is the share market. Now, the other thing that's really interesting to me is to buy property, you need a large deposit and you need a large mortgage. And I wouldn't want any young person that I know to be burdened with a large mortgage, because it just gives you mortgage stress and you can't enjoy your life. But you can build wealth through the stock market. And I have a plan, I have strategy, and I know it works. And the strategy is to save $20 a week. Who can't afford $20 a week? And after 25 weeks, you'll have $500. And that's the minimum parcel that you should invest. And if you do that, Belda, if you do that every single 6 months, save you $20, and when you get to 500, buy a parcel. When you get to my age, you'll have $1 million share portfolio. I promise you, you can work the numbers for yourself, but you'll have $1 million. And all you needed to do was save $20 a week. And of course, when inflation goes up, if it goes up by 3%, instead of saving $500, you might have to save $525 or something. So you just keep pace with inflation and save $500 to buy some shares.
Absolutely. And John, what's your greatest tip for Millennial and Gen Z investors looking to invest in shares?
Well, number one, investing in shares is not rocket science. It's pretty simple. So the golden rules are to think long term, don't fiddle, and don't think you can be smarter than the rest of the market. Now, a lot of people will tell you they've got some great stocks that they've picked. They won't tell you about the ones that didn't go well. So don't try and beat the market. Buy an exchange traded fund, an index fund. If you just buy an index fund, $500 worth every 6 months, and by the time you get to my age, you'll have exchange traded funds worth $1 million.
So John, how does the Australian Shareholders Association support investors?
The most important thing, Nelda, is, and the most important lesson is to start now. So if you wait, you won't get to the $1 million. So you have to actually start now. So anybody watching this, they can make a decision. They are either going to be wealthy because they're going to start now, save $20 this week, and $20 next week, and $20 the week after, and then buy their $500 worth. So that's the most important thing. How we can help is that we provide education. We provide education and support, and there's a lot of old people like me in the association that younger people can come along and say, well, what tips do you have? What lessons do you know that we could benefit from? If they join the association, they can actually tap in to a huge number of people that know what they're talking about, that spent a lifetime investing in the stock market, and they can pass that information on to the next generation. And we want to do that. We want to help people know how to become wealthy.
And finally, John, what is the one thing you think investors should know ahead of their investing journey?
Well, there's a lot of smart people investing in the stock market, and all the fund managers and all the stockbrokers get it wrong 80% of the time. So if you're a young person just starting out, how are you going to beat these folks? They can't get it right. So the thing you've got to do is you've got to study what an exchange traded fund actually is. And there's a company called Vanguard, and there's a guy, Jack Bogle. They should call him Saint Jack Bogle, because he invented exchange traded funds, index funds, and he did it not because he wanted to get rich, but because he wanted to help other people. And so Vanguard as a company produces exchange traded funds, and they don't have shareholders. All the money they make goes back to helping the people who invest in them. So I'm a big fan of Jack Bogle and a big fan of Vanguard.
Angel, could you outline the recent trends that you've observed in stock market participation?
So I believe that in 2020, we've seen the rise of retail trading in Australia and around the world. In Australia, my research shows that there is a 60% increase in trading volume during COVID-19. I believe the reasons are related to the lockdown, low interest rate, and also the stock market crash in March last year.
And Angel, how have Millennials and Gen Z been getting involved in investing, and what are they investing in?
According to the ASX investor report, it shows that most of the Gen Z and Millennials invest in Australian shares, followed by investment property, and a lot of them are wanting to get in the exchange traded funds market because 45% of them invest. 45% of them indicated they plan to buy ETFs in the next 12 months.
So what role has social media played in the role of investing?
The young generation, they are heavy users of social media, and young investors love the concept of investing and being able to make their own financial decision. But some of them lack the knowledge of doing so confidently, and financial advice is usually very costly, especially for the young generation. Hungry for financial knowledge, they turn to social media for free investment advice.
And what should younger investors keep in mind when reading and viewing social media, in your view? And could you share with us perhaps some tips for new investors?
So I have seen a lot of short videos on TikTok. If you look at the hashtag FinTalk, a lot of short videos about investment advice. There are a lot of investment channels on YouTube, a lot of chat groups on Facebook talking about stock investment tips. And we've seen Reddit discussion where the GameStop trading frenzy originated. So here I will talk about a few tips before you decide to follow any investment advice on social media. First, always do some research, explore the background and digital footprint of an influencer or the so-called finfluencer. Don't just assume that a large number of followers makes someone worth following. Popularity doesn't equal credibility. Look into the background and educational qualifications. While you don't need a degree to get rich, but there should be some sort of evidence for their claims to be someone worth listening to. Second, there's never a one-size-fits-all investment approach because different investors have different risk appetites, risk objectives, investment horizons, and tax position. An investment strategy that suits the influencer may not suit you. Third, I've heard that there's a Chinese philosopher saying that those who know do not tell. That it was in the 6th century, but I think that's still true in finance because why is someone sharing their secret with you for free? If an influencer really has some strategy to beat the market, they should have acted upon it themselves before the arbitrage opportunity is gone. And fourthly, always raise your eyebrows when a specific investment product or company is recommended because that potentially reflects some vested interest of the influencer. Or always check if any sponsorship is mentioned, even it could be at the very bottom of the description box of the video. And finally, be wary of those who promote ideas of day trading and get rich quick schemes. It is very common to see posts or videos about how we can become a millionaire overnight. Some claim to become full-time day trader and they encourage followers to do the same. But for amateurs, you may be playing with fire. While it is possible to make a very huge gain on an initial investment, but these are the exception rather than the rule.
Bernard, how do you define Millennial and Gen Zs, and what do you believe makes them unique in terms of their attitudes towards money?
It is the eternal question, where do generations start and finish? The baby boomers were easy to define because they started 9 months after the end of the Second World War. The millennial generation, in my view, start in the early to mid 1980s and go through to about the year 2000. And the way I would define them is that they are the children of the baby boomer generation. So my kids are millennials, of course, and that's the generation in their 20s and 30s at the moment, forming households and upgrading their homes and so forth. The Generation Z or Generation Z, I would put at effectively people born from the year 2000 up to today, so it's 20 odd years or so. And conceptually, I would argue that they are the children of Generation X, in fact. So the generation that followed the baby boomers. And their characteristics are, the Generation Z or Generation Z, their characteristics are, I think that that they are driven not so much by financial measures. I think that they are driven by the pursuit of meaning. And by that, I mean that are they investing in something? Are they doing something? Are they working in an organisation that makes a contribution, a positive contribution to the planet, to society? That pursuit of meaning, I think, really defines Generation Z or Z. All of this, of course, does prompt another question. What is the generation that lies beyond Generation Z? And I know my good friend Mark McCrindle has come up with Generation Alpha. He has switched alphabets to the Greek alphabet. So there's plenty of scope for the generations to continue with Mark's definition of the next generation beyond the Zs.
So Bernard, why are the Millennial and Gen Z generations important to the finance industry, and how should the finance industry consider including them?
Well, in fact, if you look at the income earning capacity of the average Australian, or imagine the average American or whatever, there's a very defined pattern. You tend to peak in terms of your income earning capacity around your early 30s and then continue through to the mid 50s, for example. It's about 25 years of peak income earning capacity. And for the last 20 or 30 or 40 years, in fact, it's the baby boomers and Generation X that has passed through that 30 to 55 stage of the life cycle. And if you're a retailer or a fast-moving consumer goods manufacturer or a financial service provider or a government looking for votes, then you kind of focus on those generations. But sitting behind them, of course, are the next generations, the millennials, and also the Generation Zs or Zs. So by focusing on that generation, you're really establishing a relationship with, a conversation with, a narrative, understanding the mind, the mood, the preferences, if you like, of that next generation. And the argument is that each generation is slightly different. The generation that went through the Great Depression, for example, were frugal for the rest of their lives, regardless of their prosperity. They were shaped by those events. And I suspect that the Generation Z or Z and the millennials, to some extent, will be shaped by the pandemic. I think, whether in fact they'll be obsessively washing their hands for generations into the future, it's a positive outcome, I suppose. But I think there is a focus on security, on home, community, family, meaning. In other words, a lot of the frippery of society that had dominated, say, the last 10 years or so, the whole Instagramming food and traveling and look at me kind of society, I think is going to shift, more subdued, more family, more tribal, more communal, more focused on repairing the damage, focused on climate change issues, making a contribution to society. These are the things that I think are going to motivate the next generation. And I have to say, I agree with them. They're, to my way of thinking, they're very much on the right track.
Bernard, you mentioned the importance of purpose, security, tribal and community. and really meaning before when discussing millennials and Gen Zs. If you were a company looking to appeal to millennials and Gen Zs, what factors would you consider in your approach?
Well, I think that there's a series of approaches that all companies should adopt in the 2020s, and I think that they are going to particularly resonate with that next generation of consumers, investors, of customers, if you like, and that is be authentic, to communicate well, to do what you say you will do, to behave responsibly, to behave ethically. In fact, there's any number of examples where there have been missteps, quite serious missteps over the last 5 or 6 years or so, and I'm not going to cite all of those. But I think the next generation has a very high standard of how they expect their commercial relationships, their business relationships, their employer and employee kind of relationships to evolve. So I would say that governance, diversity, inclusion, ethics, yes, you need to be profitable, all of those kind of things. But that being profitable is kind of like, that's business as usual. We kind of expect that. There is another level expected, I think, in the post-COVID world, and that is authenticity, transparency, and people doing what they say they will do. That to me is really where businesses need to focus in order to attract and connect with the next generations.
Bianca, can you start by introducing yourself and also outline why did you see the need to create Financy?
My name's Bianca Hartshee-Hazelman, and in 2016 I created the women's money blog site that I call it Financy. It's all about making finance a little bit fancy. I'd been working at the Financial Review as a journalist for many years, and I increasingly found myself drawn towards writing about women and wealth, women personal finance, women in investing, and I wanted to focus 100% on it, and that gave rise to Financy. But what I discovered through writing a lot and having children who were girls was that I couldn't find a lot of data, gendered data, that was being published in the mainstream media beyond a lot of headline grabbing stuff about gender pay gaps. This was increasingly topical at that time, and I couldn't really make a lot of sense out of it. So that gave rise to another baby of mine, the Women's Index, which is an aggregation of a lot of official data that looks at the gender pay gaps across pay, superannuation, unpaid work, paid work, leadership, education, fields of study relative to what you earn, all of these things that basically give us a scorecard on Australia's economic gender equality metric, or gender equality in Australia.
And Bianca, can you give me an overview of the latest key findings from the Women's Index?
Based on the March quarter result that's just been released, we know that women have made financial progress. There's been a bounce back in the slowdown that we saw in the December quarter. Arguably, that's been affected by the jobs fallout related to COVID and those services sectors, mainly female dominated, that were hardest hit early on in the crisis. So this recovery that we've seen, this mainly female-led jobs recovery, has been a good thing, a key highlight of the March quarter result. What does all of this mean? Well, it means that women are in a stronger financial position. We hope that that continues, because ultimately that will help towards better financial security, more money when it comes to investing, and a greater a reduction in the time frame towards achieving gender equality. Now, when we look at gender equality, what we've also learned from the March quarter is that it still remains the case that we're sitting at about 101 years to achieving gender equality. That's based on the worst performing sub-index, which of the Women's Index, which is unpaid work. So women are still doing the lion's share of unpaid work, be that at home or in the workforce. So that acts as a major barrier to workforce participation, paid participation, which of course impacts financial progress. So that's an area we really need to work on. Where there has been gains in the March quarter is in the employment sub-index in relation to gender equality. So we've seen an improvement in gender equality in the workplace in the March quarter. Now, this is a good thing, And that's been because we've had record increases in female workforce participation. We have more women in full-time and part-time work. We've seen huge bounces actually in the recovery in retail trade and food accommodation, particularly among over 35s. So this has been a good thing for progress for the Women's Index score in the March quarter.
So Bianca, what are the 6 things that the Women's Index has taught you and you think that could help others?
So the 6 things that the Women's Index has taught me over the past 4 years relate to 6 key areas, quite obviously. Unpaid work. Ask yourself, how much are you doing? Where can you make some changes to benefit your paid work capacity? Superannuation, what does your balance look like? Have a think about that. Where does it stand to the average? Leadership, where could you be leading more in your life at home or at work? Where do you want to be? Underemployment, where do you want to be doing more work? Where are you not doing enough? Where are you available to do more? That one's really about capacity. Employment, what is your employment situation? Is it actually working for you? Is it flexible? Is it not flexible? Do you want it to be? And income, so that all relates to our gender pay gap story. What does your wage look like compared to your peers? Are you actually having those conversations with your friends on pay? Don't be afraid to front up to discussions around pay. So these are the 6 things that are critical to your financial progress, 6 areas, and I really encourage you to have a think about how they relate to you, because once you start to think about that, you can start to make changes to enhance your own financial progress.
Mark, how do you define the generations and why do you believe it's important to understand the emerging generations?
Generations now span 15 years. And that gives a good amount of time because within that time, people share an experience, the technologies, the events, the social markers that leave fingerprints on a cohort in their formative years is shared within that 15-year time span. Sometimes we think in 2 or 3 year cycles, that's too short. Sometimes if we look over history in 40 or 50 year spans, that's too long. But you know, take the millennials or Generation Y from 1980 through to 1994. You know, that's a transformative era. As they were coming of age, so was the internet, and so was the technology of interaction. And then you've got Generation Z from 1995 to 2009, and that was the era of social media as they were coming of age, and a whole global connectivity. And so from 2010 through to 2024, we've got the next generation. Having got to the end of the alphabet with X and Y and Z, we're going to Generation Alpha, and they're emerging as well. So 15-year span is how generations are defined. And it's not the only segment to look at, but it's the essential first one to understand.
And Mark, how is interaction and communication changing as society evolves?
It's changing massively because we do tend to resemble our times more than we resemble our parents. And our times in terms of communication and technology and interaction have been transformed. I mean, think about the emerging generation into the workforce, the new generation of wealth accumulators. They are global in outlook and digital in tool and social in influence channel. They're mobile in terms of where they'll work and live and interact. And of course, they're visual in terms of the content style that they consume. It's no longer just the written form, it's the visual form.
Mark, when it comes to investing and finance, how are younger generations approaching this in ways that the older generations didn't?
Well, because they're across the peer group and social media, they're more aware of the new investment classes. They're technologically focused. So obviously crypto is something that they're interested in or aware of, whereas the older generations bring a natural skepticism to some of these new investment categories. They, in a sense, don't have that same pattern of history, and so have only seen assets rise, haven't been through the tough times, notwithstanding COVID, which has created great uncertainty and volatility globally, but they haven't had the recessions or indeed seen high unemployment, apart from, again, the little blips of the layoffs in the peak of COVID. So that has given them an optimism and perhaps not the same level of resilience and preparedness for the rainy day that of course does come. That's one of the differences we see with them. The older generations bring that skepticism, they bring that longer term perspective, and they know that charts go up, but they also go down, and that does help them diversify a little bit more. So there's a bit more of an education to come for the emerging generation, but at the same time, they're across some emerging assets and new investment forms that the older generation probably won't see the benefit of.
And finally, Mark, we've got Millennials and Gen Z coming through now. What comes after that?
Yeah, that's right. Well, there was us Gen Xers and then Generation Y that also are called Millennials, and then Generation Z. So Generation Alpha are the children today. They're the children of the Millennials, of Generation Y. And so they're being shaped in this whole new level. I mean, they were born in 2010. That's when they began being born. That was the year that Instagram was launched and the iPad came around, and word of the year in 2010 was the word app. So that tells us something about the digitization of their experience. And of course, the age at which you're exposed to these devices, technologies, events determines how embedded it becomes in your lifestyle and in your psyche. And so we can expect the Generation Alphas to be even more of a full-on version of what we're seeing today with the Gen Zs. And so that global digital connectivity will really define them. They're already influencing parental purchases. They're already spending beyond their own means because they can influence others. They are the cohort that the pop culture and the social media world wants to connect with. So they've got power beyond their means. Demographically, they'll be the largest generation globally in history, part of the largest emerging middle class ever, and the most formally educated and digitally supplied generation ever. So understanding the Gen Alphas will be key to thriving into the future because of just their influence, their size, and their scale.
I'm Lee Martin Seymour. I'm the CEO, co-founder and director of xref.com. Our ticker code is XF1. We provide a platform out to enterprise employers all over the world that takes care of pre-employment reference checking. Before you hire someone, you need to know who they are, where they've been, and what they've done. So about 10 years ago, we started our life in automated reference checking. We built a platform to remove the arduous task of checking a candidate out. And progressively over that 10 years, we have grown globally and become public. Today, we pepper in things like ID checks and additional checking from outside vendors that provide us with things like police checks and working with children checks and director checks. So there are 60 of us globally around Asia Pac, EMEA and North America. We now have a revenue run rate of about 15 million a year. We service about 1,200 enterprise clients globally, many of which you will know as household names. In those companies, we have about 8,000 users, and our revenue streams are a mix of prepaid credits, post-paid additional checking revenue, and subscription revenue. And all of those percentages can be found on our presentation. We have, over the last 10 years, provided our service to people that use it natively. So they log into XREF every day and check the people that they're going to hire. However, about 5 years ago, we started to provide our service through integration partners, ATS checking services globally, people like Workday and Oracle, smart recruiters. So if a recruiter or a talent acquisition lead uses a business as usual tool during the day, they can integrate XREF within that. We also sell our reference checking technology out through a wholesale agreement to the likes of CV Check or Equifax globally, where they want to use our automated reference checks within their own checks. But our future across FY22 involves us moving from recruitment and across the candidate hire to retire life cycle. So offering our platform for use by HR with current employers, employees, and then extending that across using our platform for people that are exiting the business and doing things like exit surveys to sort of conjure up lists of alumni that you could possibly rehire. So we are extending our platform this year, and in the first half of FY22, we'll be introducing things like pulse checks, further additional checking and exit checks to not just our new client acquisition, but also the huge foundation of enterprise clients that we've got globally. So, very exciting. And to find out more about us, we have a wealth of information on our website, on our social channels, and we have a purely investor-driven website, xf1.com. And on our presentation, you can find our IR contacts and anybody else you'd like to speak to, including me, about the future of the business. When it comes to ESG, a platform like ours was built 10 years ago to replace an arduous paper-driven workflow. So providing our service out to employers globally that is purely paperless, and even provided through the Amazon Web Services and microservices infrastructure, keeps us exceptionally lean when it comes to environmental issues. However, when we do provide our service out to those employers, what we're actually doing is safeguarding them from hiring people that they probably shouldn't. So if you think about the mix of our clients, we're very heavy on healthcare, education, not-for-profit, government, aged care environments. So it's really important that we make sure for our communities around the world that we're hiring the right people. And companies that people trust the most tend to trust XREF to get hiring right. And then when it comes to data, the world is very sensitive on both the handling of data, but then an individual's privacy. So when it comes to GDPR, we help clients around the world make sure that they safeguard themselves from breaches in privacy, discrimination and fraud. And then we put a wrapper around that. We've got a global passport in data security, which is called ISO 27001. So when it comes to ESG, we really do, even though the size of XREF, we take it very, very seriously in terms of those three things. So thanks for tuning in and giving us a bit of airtime. Welcome to the journey. It's going to be a journey of profit, growth and product, and please follow us.
Hi everyone, thanks for joining me today. My name is Fleeta and I'm the Managing Director of Little Green Pharma. And Little Green Pharma is all about transforming the lives of people around the world. We produce pharmaceutical-grade cannabis medicines to treat a wide variety of medical conditions. So we're strictly medicinal. We operate across a vertically integrated business model. So this means we operate across the entire supply chain. So that means that we actually cultivate our own cannabis plants, but we also manufacture them into final medicines for patient use. We think that this is really advantageous in such an emerging and new industry because we can really see where the opportunities lie, and most importantly, where value can be captured in each of these supply chain activities. We're Australia's first producer of cannabis medicines, and we've been generating these medicines since August 2018. We were also the first Australian company to export overseas, having patients across the globe who are benefiting from our medicines. We currently have about 12,000 patients in Australia, and we've actually sold more than 60,000 units of medicinal cannabis medicines in total across the world. Last quarter alone, we generated a 2.46 million in revenue and entered the quarter with 28.5 million cash at bank. And our vision is to do extraordinary things for patients, and our purpose is to solve real patient problems. We have a very clear strategy to achieve this vision, and this is how we'll grow. First of all, patient acquisition in Australia. Being the first company in Australia comes with first mover advantage, and brand equity is everything. We estimate we've got about 20% market share in Australia, and this is a really solid demonstration of market validity for the new and emerging markets across the world that we're aiming to target. And this is point number 2, commercial sales volumes in overseas markets. This strategy is really important because this is where we aim to make the most profits. LGP's total addressable market is estimated at $23 billion currently. We're on a really good solid track. We've got firm purchase orders from a company in Germany, and that is for 5.7 million Australian approximately in 2021 calendar year alone. We're also supplying into a French government medicinal cannabis trial. And this is significant because it's this trial that's likely to catalyse the French medicinal cannabis industry. And that's a huge market. We've also shipped to a number of different countries, so including Germany, France, the UK, New Zealand, and even Brazil. So we're right on track to achieving this strategic growth point. Finally, our end game. And this is so important to Little Green Pharma. It's the innovative drug delivery technologies. And this is what's going to solve real patient problems. This technology that we're currently working on aims to generate really small sized particles of active ingredients intended to facilitate improved bioavailability into the human body. And we're looking forward to doing human trials soon. We are so fortunate in that we solve many ESG challenges through our core business activities. Based on the Boston Consulting Group's model, there are 6 dimensions of impact that we look at, and we're really strong in several of these. First of all, the lifetime well-being. This is what we do. We transform lives, and our core business is improving the quality of life of people. In fact, we've initiated the Quest initiative with the University of Sydney, which aims to be the largest observational study ever done using cannabis as the medicine for quality of life purposes. So through this Quest initiative, or the Quest study, which is ethics approved, so important, we drive compassionate and patient access, patient affordability, and much needed education for wider stakeholders. Our operations are in regional Western Australia, so we provide employment and skills training for over 60 people in a southwest community. We proudly employ nearly 60% females, and the age of our employees range from 21 to 73, with 44 being the magic average age number. We aim to continue improving our carbon footprint. We don't use pesticides or other nasties. And we've switched from HPS lighting to LED lighting to save power. However, we're only young, the industry is new, and we're still learning to optimize our operational efficiencies. So we aim to continue exploring renewable power as we expand our operations. Thank you so much for your time today. Please connect with me directly. You can find me on LinkedIn or at fleeta@lgpharma.com.au. We love to welcome you to the Little Green family. Thanks very much. Bye for now.
Maximus Resources, we're an ASX-listed gold and nickel producer with an ASX ticker code MXR. This picture is of the Wattle Dam gold mine, produced just over 8 tonnes of fine gold. We love this picture because it just shows the opportunity for another discovery of a highly profitable gold mine. So we're located in world-class gold and nickel location, Western Australia's premier gold and nickel district, Australia's gold and nickel capital. We've got 108 square kilometres of granted mining licences and gold rights, which hosted the very high-grade historical Wattle Dam gold mine. We've got a fantastic resource base to build off of 112,000 ounces and located within 50 kilometres of 7 gold processing plants, which allows for a low-cost start-up operations. And also dual focus with nickel, and located 25 kilometres from BHP's Kambolda nickel concentrator. We're a newly formed management team, and I'm supported by Dr. Travis Murphy, PhD structural geologist. Very quickly, this is another picture of our Wattle Dam gold mine and our newly interpreted mineral corridors. So there's 2 mineral corridors, Redback and S5 and Golden Orb. The Wattle Dam gold mine, as mentioned, super high grade, one of Australia's high grade gold mines, was mined by Ramelius Resources until 2012, produced 270,000 ounces at 10.5 grams per tonne. And the assets were transferred to Maximus in 2015. Significant amount of mineralisation left in the high grade, next to the high grade chute, and work's underway to evaluate a mineral resource estimate for this. Greater Wattle Dam area, we believe that we're sitting on a much larger mineralised gold system here, and to the 600 metres to the south, we have Redback inferred resource of 440,000 tonnes at 3 grams. Historical drill spacing across this area has been too broad, and as recently discovery at the start of this year, S5, there's further discoveries to be made in this area. The Redback deposit, as mentioned, 600 metres to the south of Wattle Dam Gold Project. We've had some really spectacular gold intersections at the start of this year, highlight being 16.3 metres at 9.3 grams and 5.8 metres at just under 18 grams per tonne. So spectacular high grade gold intersections. And we've been able to now to trace this high grade chute from 40 metres down to 250 metres below surface, and it remains open at depth. Earlier in this year, the company was successful in the application for a WA co-funded drilling grant, and this is for 2 holes to test potential doubling the plunge depth of Redback. So we're planning to drill these holes later in the second half of this year. And also mentioned, we have a dual focus with nickel exploration. We have nearly 20 kilometres of potential strike, and there's a near contiguous belt of nickel deposits and mines that finishes on the doorstop of our tenements. Nickel exploration was not the focus for the previous ownership, and we have identified several high priority nickel targets, which will be completing ground geophysics in the second half of this year. So a corporate snapshot, market cap of just under $10 million, and a highly experienced board. So why invest into Maximus? Location, tier 1 location, fantastic prospectivity and project access. We've got a strong foundation to build from, 112,000 ounces, and demonstrated high-grade discovery potential. We're a dual commodity strategy with gold and nickel, and several near-term growth strategies with resource estimates and gold and nickel exploration through the remainder half of 2021. So strong news flow, and we're an experienced board and successful mine builders. So thank you very much.
Hi, I'm Chris Noon, CEO of Carly Holdings Limited. Carly Holdings is a company that's focused on the mobility industry in Australia. Some of our shareholders include SG Fleet, the largest fleet manager in Australia, Turners Automotive, the largest seller of cars in New Zealand, and also RACV. We provide Carly Car Subscription. Subscription is a monthly recurring payment for access to a vehicle that includes insurance, registration, servicing. All the customer has to pay for is petrol for the vehicle. Our research shows that 38% of Australians would consider car subscription. In terms of ESG, we have some great benefits. We are using idle cars that are usually sitting around doing nothing and providing them to individuals and businesses who can make productive use of them. We're also providing a pathway to electric vehicles to allow more people and businesses to trial this technology and adopt it as their major form of mobility. A car subscription is a 30-day recurring subscription. You pay a monthly payment for access to the exclusive use of the car. It's suitable for both individuals and also businesses, and includes all of the costs of ownership except for fuel and tolls. So we take away all the hassle of servicing, of paying for insurance. There are no upfront deposits and no break fees, and subscription is an alternative to long-term finance and debt. The way that people use cars is changing rapidly. People are seeking mobility solutions. They're not just seeking a car that will drive them from A to B. They're no longer seeking a car that they own for 3, 4, or 5 years. They're seeking the ideal car that suits their needs right now. And if those needs change, they want to be able to change the car. And we're seeing this very much with the adoption of electric vehicles, where people want to try this technology, don't quite understand it, and want an easy pathway to trial it and then choose the right option that's best for them. So car subscription fits between car rental, which is for shorter periods of time and is usually quite expensive, and also outright purchase and long-term finance, which lock you into a vehicle for 3, 4, or 5 years. The average subscription period for Carly is 5.3 months. We act as a virtual business. We're an online platform. We connect owners of vehicles who could be manufacturers, automotive dealers, or corporate fleets with demand from individuals and also businesses. We've had great growth despite COVID-19, and the pandemic has actually caused a lot of people to look at their expenses, look at their financial commitments, and look at different ways to meet their mobility needs, and subscription has been growing since that time. We've done quite a bit of research into subscription, and as we look at younger generations, the propensity to be interested in car subscription increases. 50% of millennials would consider car subscription for their next vehicle, and 69% of Gen Z. We've been operational in the automotive industry for a number of years now. We have a wide range of partnerships with respected companies and great examples of technical integrations with these companies as well. In terms of our ESG credentials, we look at this in 3 different ways. We utilize existing vehicles. We're not increasing the number of vehicles in Australia. We're making better use of vehicles that are already existing but are not being currently utilized. And we put these in the hands of individuals and businesses. We're also providing access to electric vehicles. We work with manufacturers and dealers to provide subscription options for electric vehicles to allow people to trial them, understand whether they're suitable for them, and then potentially make a longer term purchase of those vehicles. We're also seeking to lower the emissions from vehicles as well in offering a fairly new fleet and also offering access to electric vehicles. We're helping to decrease pollution and increase quality of life for people in Australia. So Carly is the only subscription business that is listed on the ASX. Our ticket code is CL8, and please follow us on our social channels. Thank you.
Michael, could you tell us about your role at S&P Global and how you got into ESG investing?
Pleasure to be here. And my role at S&P Global is to lead the ESG business in Asia Pacific as part of the Sustainable One team that's newly developed at S&P Global that sits across all the divisions: index ratings, Platts, and market intelligence, data and analytics. And I see it as the glue, the ESG glue that brings together all of those solutions in terms of providing a sustainability option and outcomes for our clients.
So, Michael, what key trends are you seeing in ESG today?
The key trend in ESG today is the momentum, the momentum behind the adoption of ESG investing overall. And I think this has come from the reality that ESG is impacting how we live our lives as consumers, the future that we have, and having that future, providing a future for our children in a way that we live today, and that companies and governments play a major role in that, and that as consumers and investors, we can contribute to a better world. There's a very strong focus on climate change, and we've seen that the focus on climate change is coming because of the real impacts that are happening to our lives. So it's very visible, the impacts from climate change, the hazards that are affecting our lives, and these hazards affect companies as well. And so through changing our behavior, through transitioning to a low carbon future, we have the opportunity to reduce the impacts of climate change and create a better world. Definitely one of the big changes that we're seeing, and it really does cover more than just physical hazards on assets. It's affecting people and their lives and local communities. So it is a social issue as well. And that's why I think that if we see the trend that's being followed mostly at the moment, it really is a climate change focus.
And Michael, what advice do you have for ESG-focused investors?
ESG-focused investors today have a wealth of information to look at, which is far more than they had even 2 years ago. Overall, there's two aspects to the way investors consume ESG data. One is that ESG data is providing insights into risks into your investments, and these risks are being shown. There's evidence that these risks are real: environmental impacts on companies, social license to operate, and as well as identifying risks, identifying opportunities. Opportunities in renewable energy is one of the areas that has a strong focus at the moment during the energy transition. These can be viewed and are similar to the same risks and opportunities that companies have been analysed by investors for years. So in that respect, ESG data is just providing a greater wealth of information to better know the companies you're investing in. And the other aspects of ESG investing is through the values of the investor. So this is where you're able to provide a view on what you feel you want your money to capitalize, and whether that's a particular area of ethical investing, like avoiding alcohol, gaming activities, or tobacco, or weapons as popular ones, or whether your concerns are more around fossil fuel exposure and minimizing that exposure as we transition to a low carbon economy. I think what's really important for investors is everyone in Australia at least has a superannuation. So use that voice that you have through your superannuation to encourage your super funds to continue the good work that a lot of the super funds are doing in the ESG space, because they're able to engage companies through the weight of the capital, the accumulated capital that they have, and we've seen that as a positive over recent years. I'd finish that, Leld, with just a thought. I'd say, be bold. Be bold in your ambitions around focusing on sustainable outcomes, because I feel that together, we do have the ability to transition global economies to become more sustainable, more equitable, and more SDG aligned.
So, John, we all know issues like climate change are a major issue. We're all trying to live more sustainable lives, but how do you believe we can shift our investments to be more sustainable?
Lelda, great to be here. Look, you're right. We all know about keep cups. We all know about riding our bikes to work. But one of the most impactful things we can do is actually look at our investments. We choose where to shop. We look at where our shoes come from, but do we look at the companies we're investing in? And now more than ever, there's a really exciting opportunity because there's so much more data available. And there are funds like ESG ETFs and impact investment funds that are aligned with a particular theme, and that we can align with our values. And issues like climate change, we can find companies that use less fossil fuels, and we can avoid those that might mine for fossil fuels or use a lot of energy. So a lot of options available today.
Fantastic. And John, could you please tell me more about these terms like ESG and impact investing? What's the difference?
Yeah, look, I see it as the spectrum of sustainable investing. And I think ESG is a really great starting point, but that's at sort of the early part of the spectrum. And down the other end of the spectrum, the deep green end is impact investing. That's where you can have the most impact. So ESG It stands for environmental, social, and governance. And that means that investors consider environmental, social, and governance factors, which is energy use, it's gender diversity on the board, how they treat their staff. So really, it's a risk overlay. It doesn't really have a lot to do with your values. Really, it just means that rather than purely looking at the financial statements, an investor is also looking at these other factors, environmental factors, workers' rights factors. And these are issues that we're realizing really quickly are actually financial issues, and they're hitting the bottom line. So they're more important than ever. Somewhere in the middle there, you have investors that use engagement and stewardship, where they've moved beyond just divesting from companies and saying, I don't want to invest in that stuff. They're actually, the companies they are invested in, if they're not happy with the way they're behaving, they're engaging. They're setting up meetings, they're going to the AGM and putting their hand up and asking questions. And that is having a really positive impact. And then you've got at the other end, impact investing. This is probably the most challenging, and that's why it most often is involved in the private markets, where investors can have control of a private company. They can get on the board, they can have a large shareholding, and they can be really instrumental in building the company. And they do that with companies that have a core theme, that are trying to solve a really clear issue. And one of the most interesting things there is that they build an impact measurement program. They find ways for the company to better measure the impact they're having on the environment, on the communities they work in, they operate in. And that impact measurement is, I think, it's sort of echoing throughout the world, really, and that all businesses are now finding that they need to report on more factors than just the financial. And that's having a huge impact.
So finally, John, what kind of returns can people expect to make when they embrace ESG and impact investing approaches?
Look, no returns are certain. We all know that. But what we can do is look at the track record in the past, and we can look at how indexes are matched against benchmarks. And in 2020, ESG investing did really well. There are lots of reports that have talked about how ESG indexes beat the mainstream benchmarks. And some cynics may say, well, that's just because the tech stocks were on a tear because we're all in lockdown. But then you've got groups, well-regarded groups like RIA, which is the Responsible Investment Association of Australasia. They've put out long-term research that looks at the 3, the 5, and the 10-year track records of these ESG funds. And across all those periods, they still beat their mainstream benchmark. So this idea that if you want to invest sustainably, you have to make a trade-off with returns, that's a myth, and it's long dead. So, you've now got more information. You've got more information to make a risk decision. And in the end, that's turning into a better investment decision.
Now, ESG and ethical or value-aligned investing has been around for some time now, but the expectations are increasing on what ESG funds should look like. What do you look for when investing?
Yeah, thanks for the question. So ESG or sustainable investing has come a long way and has had a pretty big acceleration over the past 2 years. So you can't really open a newspaper these days without a headline on climate change or modern slavery issues or decarbonising the economy or cultural concerns within a business. And investors are really starting to take note of what they're invested in. So they're looking at the holdings, they're checking out their superannuation, and it's no longer acceptable to call yourself an ESG or sustainable or SRI fund without having a rigorous process in place or being truly authentic. So I help to manage the perennial Better Future Trust and also the E-Invest Better Future Fund, which is an active ETF quoted on the ASX under the code IMPQ. And these funds go out and actively seek companies that are contributing to a better future. So whether that's improving educational outcomes or employee engagement or providing renewable energy or a company developing low carbon technologies, they might be contributing to a circular economy or improving health outcomes.
And can you explain what greenwashing is? Why is it a risk? And what are you doing to avoid it?
Yeah, absolutely. So greenwashing is a concept that has been coined to describe companies or funds that may claim they're green or sustainable, but those claims aren't substantiated, and often it's just a marketing ploy. So it is a risk from an investment perspective, because if they aren't actually environmentally friendly or managing their supply chain in an ethical way, that risk of ESG controversy still exists. But additionally, they also expose themselves to reputational damage. And this can have an impact on share prices. And we've seen that happen in the past. I guess what we try to do to look through the claims is focus on company engagement. So as active managers, we have the ability to go in and meet with management teams or board of directors to discuss ESG and sustainability in their business. And this really provides us with an indication of authenticity. So we do a lot of due diligence as well, and that might involve talking to clients or suppliers, verifying claims that they've made, or monitoring external sources for information.
So can you give me some examples of listed companies that you think are doing a great job with ESG, or perhaps ones that you've even invested in?
Yeah, great. So we think companies that perform well in sustainability are just better run businesses. So typically they have management teams that are aware of their ESG risks and opportunities, but also a whole range of other broader risks and opportunities in their business. A really great example of one of these companies is Janison Education, which is listed on the ASX under the code JAN. And Janison creates online assessment and learning platforms for educators or corporations or governments. And we really like Janison because it's a more efficient way of conducting examinations than traditional pen and paper exams. And also it allowed examinations to continue over the COVID period, so to have virtual exams and testing platforms. So also the test can actually be modified to improve outcomes for the student. And it also has significant growth opportunity as a business. So its existing clients include people like the CFA Institute, the OECD, and the British Council. And it is currently profitable and trading at a significant discount to its other SaaS peers. So that's one example of one of our better future investments, which is in the education space. Another example is a business called Calix, which trades under the code CXL. And that's an industrial company which provides products and services solving global sustainability challenges. So ESG is really their focus, and it's all through their presentation materials, and management and the board discuss it with investors all the time. And they're, of course, a beneficiary of the increasing focus on ESG and sustainability as more and more flows come into that space. We've had really positive engagement with Calix, and they actually appointed a great, well-qualified, independent female non-director exec NED to the board. And that was after years of us engaging with them on the benefits of gender diversity. So that was a really positive outcome. But one of their really exciting projects, which gets spoken about a lot, is the CO2 mitigation in the lime and cement industry. So we know that the lime and cement industry contributes to 9% of global greenhouse gas emissions. And so what they're doing is that they've created patented technologies to do carbon capture and storage in the cement process. And they recently announced partnerships with Adbury and also Pilbara Minerals. And the last example I'll talk to today is a company that I'm sure you've probably heard of before, but Kathmandu, which is under the ticker KMD. And Kathmandu is an outdoor apparel and equipment company, and they also acquired Rip Curl a few years ago. And Kathmandu, is in the retail space, so not one that's traditionally thought of as a sustainable industry, but they do have sustainability at the core of what they're doing. So for example, they use 100% sustainable cotton. They're a certified B Corporation. They also have recycled 20 million plastic bottles into their materials. And they also just recently announced the world's first biodegradable fleece. So I hope that's given you a few examples of some of the really innovative small companies listed on the ASX that are really sustainable, both for contributing to better outcomes for the environment and society, but also just really doing good things at their core. And that's how we believe that we've been able to generate really strong performance over time.
Jerome, how do you believe Millennial and Gen Z investors get involved in ESG investing?
There are really two main ways. One way is to pick individual stocks, individual companies. The other way is to invest in a mutual fund that takes these into account. If you are going to invest in individual stocks, then you really should research a little bit about the company. You should read news articles, or you should know something. And if you can't do just a little research and look at some ratios, then probably you should invest in a mutual fund. That would be my advice.
And what are some ESG stocks that you've been a fan of over your extensive career in the US?
Let me give you one that's done very well for us, and another one that I like very much that hasn't done well, but has perhaps some potential to go in, and it might be a good investment right now. Okay, the one that's done really well for us has been Apple Computer, which I'm sure most of your viewers will know what Apple is. And what an amazing company, starting out, making personal computers. And now, of course, Apple, really, it's the phones. In fact, I'm sure a lot of the people watching this program will have phones that have an iPhone, of course. But they treat their employees well, good charitable donations. So I think it's a really good company. So it's a good long-term holding. It would have been nice if you could have bought it maybe a couple of years ago before it ran up so much in price. But if you have it now, it's probably good long-term. Another one that I would like to recommend, or at least have you think about, is also a technology company. It's called Intel, I-N-T-E-L. And what they do is they make the chip that runs computers. It's one of the biggest chip companies. So it's a very good company. It hasn't done as well recently, primarily because the new generation of chips that they are producing, that they have lost. Intel used to be ahead of anybody else, AMD, any other chip maker. And what's happened is that it's lost its lead. So the stock is not doing as well. So it's really good value, but you never know. Are they going to improve? Are they going to come back? My personal opinion is yes, but you never know. So when you're doing value investing, you have to say, okay, you have to be prepared for some wins and some losses. But if Intel comes out of the slump that they've been in, it's going to be a great investment. So I think that's one thing that you might want to think about. So those two companies are both technology companies. They're both good companies. Apple, one that's selling at probably the high point, and Intel, one that's maybe possibly has more upside potential. But those are the two that I would like your viewers to think about.
So, Jerome, what are the biggest issues facing ESG investors in the future, and what are the issues that perhaps concern you the most?
I think the most important thing right now are these funds and investment advisors, are they sincere? Are they knowledgeable? Are they doing work? And if you're a consumer, if you're an investor and you want to invest in their fund, or you want to get advice from a broker or from an investment advisor, really you need to think, does this person, did they do the research? Is it really important? Because you want to invest in the companies that are sincere and that practice what they preach. And the reason is that by investing this way, there's certain advantages. So for example, if you invest in a company that's environmentally responsible, it's unlikely to get fined. It's unlikely to be sued. There's certain things, the benefits. Also, if they are careful about their use of water, use of materials, that's a big plus because you don't have to spend as much money. So if you use less raw material, so I think the conservation standpoint is very important in my view for the success of the company. Also, how about their equal employment opportunity? I mean, we've got women are basically half the population of the world. And for so long, they weren't really given the opportunities that the men had. And now, of course, there's more opportunities coming in. Some of the top firms are being managed by women. They're bringing their talents, in many ways, displacing men, okay, a lot of them. And I think that having this equal opportunity means the best talent that you can get. And when you have women, or if you have people from other, minority groups, they're not necessarily white, but are, if you open it up to everybody, I think you're going to get the best talent. And that would really help investing. So I think that's an important thing to look at in your investing practice.
My name is Thomas Orton, and I'm the Head of Corporate Development and Investor Relations
Adriatic Metals. Adriatic Metals is a junior listed mining company, and we are listed on the London Stock Exchange and the Australian Stock Exchange. And our flagship project is the Vares Silver Project, which is based in Bosnia in southeastern Europe. We did a PFS on the Vares Silver Project in October of last year, and the economics are truly world-class. And that is because the Vares project is one of the highest grade undeveloped polymetallic projects in the world at the moment. We have a very high NPV and IRR and a low capex. The reason the capex is so low is that we are not building a camp mining operation. We are very much relying on the existing infrastructure, which is in place and close to the project, which was built by the Yugoslav state mining company, which ceased operations in the area in the late 1980s. The region of Vares has a very rich culture in mining and a very much rich history, and it's very supportive of our mining operation. The mine is a brownfield site, and we will be building an underground mine called the Rapitsa mine. And it is the high grade in that Rapitsa mine which really drives the incredible economics. As you can see in the graph in the bottom left-hand corner, the cash flows are very much front-ended, and we'll be averaging 200 million in post-tax free cash flow over the first 5 years. And that is why our payback period is so low at just over 1 year. Our cash costs are just under $10 per silver equivalent ounce. And if you compare that to the silver price today, which is around 26, 27 US dollars per ounce, as you can imagine, it's not going to be much of a problem raising the construction finance to put this project into production. Not only is the Vares project making an incredible return for shareholders, but it is also making an incredible contribution to the economy of not only Bosnia and Herzegovina, but also the local community around the town of Vares. During the construction years of the project, we expect to be 17% of Bosnia's foreign direct investment. We'll also be the country's largest exporter, and will be contributing around 1.5% to the economy's GDP. Now, these are big figures, but what does this actually mean in terms of contribution? Well, over the life of mine, we are expecting that we'll be making almost 170 million euros in tax revenue payments. So not only have we caught the attention of government and got a huge amount of government support, but also the community as well around the town of Vares. Achieving community and government support is one thing, but maintaining it is something else. When you move to a community and build a mine in that community, you first got to understand the needs of that local community and include those in your development plan. One of the many initiatives that we've done in order to respond to those needs is set up the Adriatic Foundation. The Adriatic Foundation is a charitable trust designed specifically to improve education, environmental protection, and healthcare within the local community. But what's unique about the Adriatic Foundation is that it is run by a board of trustees who are independent of Adriatic Metals and who are members of the local community of Vares. It has been seed financed by directors and founders of Adriatic Metals, and there's an ongoing funding commitment from profits. But what's really important about this is it empowers the local community to make investment decisions on improving those three needs, rather than the company doing what it thinks is best. Adriatic Metals has only existed for just over 4 years, and in that time we've achieved a hell of a lot. But in terms of exploration, we've only really just scratched the surface. We've delineated 12 million tons of high-grade underground resource at Rapitsa in the northwest. But as we systematically work our way down the strike length along our concession area, we expect to find repeats of this Rapitsa-style mineralization to feed a central processing plant. And we do truly believe we're going to be here for decades, and that's why we've allocated a large exploration budget for this year. So the next 3 months is going to be an incredibly exciting time for the company. We've got update on permits, completion of DFS and project finance. But actually longer term, we're in a highly prospective mineral belt, which is incredibly exciting. And I hope you share the excitement with me. Thank you very much.
Hello, my name is Joshua Fegan and I am the Chief Executive Officer of Althea Group Holdings, a global leader in the manufacturing, sales and distribution of cannabis-based medicines and adult use cannabis products. We have two separate divisions, the first concentrating on cannabis-based medicines and the second focusing on recreational or adult use cannabis products. Beginning with cannabis-based medicines, we have one of the world's leading brands of cannabis-based medicines in Althea, a range of products that are sold now in Australia, the United Kingdom, Germany, and we are also entering other markets as we speak, including South Africa. We have upwards of 20,000 patients that consistently use our products for some pretty serious conditions, most of which are indicated for pain, things like anxiety and sleep disorders. Second to Althea, the brand of medicines, we have one of the world's first software as a medical device known as Althea Concierge, which does a lot of things for patients, for doctors and for pharmacists who really know very little about cannabis-based medicines and are starting from scratch. The app itself facilitates treatment plans so that patients know exactly how much of their medicine to take and when they're new to the treatment, and feeds back that information to their doctors so that their doctors can understand how the treatment is actually working, or if it is working for the patient, and monitor them closely. In the United Kingdom, we also operate one of the country's leading private healthcare clinics. The business is known as My Access Clinics. It has around 1,000 patients in treatment. And again, our specialists service the areas including chronic pain, mental health, so psychiatry, and also sleep disorders. Moving on now to recreational cannabis. We operate a very cool business called Peak Processing Solutions, which we purchased in 2019, which is focused mainly on recreational cannabis. Recreational cannabis products are legal in Canada, so products are sold through dispensaries, which pretty much look like retail shops. But we really see recreational cannabis as being more lifestyle products that people consume in social settings. In other words, it's the way of the future. People are more health conscious than they have ever been before. So less people are drinking or consuming alcohol and tobacco products. Cannabis itself is a very healthy alternative because it's non-toxic, it's less addictive than caffeine, and the preparations in which cannabis are now being sold in a final form product is very exciting. Althea Group continues to grow at a rapid rate. We are the leaders in the medical cannabis space and will continue to do so through our in-field activities where more and more doctors are prescribing our products in more and more countries. On the recreational cannabis side, which again is very exciting, it is about working with big brands to bring their final products to market in Canada. What that means is Peak facilitates the product development, the manufacturing, the regulatory and the distribution of cannabis-infused products. For example, a big alcohol company might want to diversify their portfolio away from just supplying an alcohol brand or brands. They would like to have a cannabis beverage. They would approach Peak. Peak work with them to bring that product to life and get it into market so that that big brand can concentrate on what they do best, and that's sales and marketing. Althea Group is a multinational business. Therefore, we pay particular attention to diversity across our workforce, paying particular attention to the different cultures. We also have a strong focus on environmental, social, and governance. Governance is basically assumed considering we operate in highly regulated markets. In terms of the social side of things, we do our best to lobby for patient access to medicinal cannabis products, especially knowing that it has the capability to change lives. Environmentally, we do whatever we can to minimize our impact on the globe, especially when it comes to cultivation and manufacturing practices. The future of Althea Group Holdings is very exciting, especially as we continue to impact positively on patient lives all around the world with our cannabis-based medicines.
We also have increasing revenues, including recognising more than $5 million in the first half of financial year 2021. We see extremely good growth in recreational cannabis, including the $4 billion Canadian market, and we see further growth through the US and Mexico in the coming months and years.
Hexagon Energy Materials is an Australian-based company which is solely focused on sourcing the elements required for the meeting of the world's energy needs while lowering emissions and greenhouse gases on the path to a sustainable future. The company has a number of projects focused on meeting future clean energy needs. One of the challenges meeting the demands of the transition to new energy is how to source the necessary materials in the lowest impact way for both the environment and the atmosphere. Hexagon is focused on implementing world-leading practices and technology in order to achieve this. The 100% Hexagon-owned Paderca hydrogen project in Australia's Northern Territory aims to produce zero-emissions hydrogen at commercially attractive cost to help to accelerate the growth of hydrogen economies and the decarbonisation of energy use. There's been a lot of attention given to hydrogen, which is produced through electrolysis of water, that is, splitting the hydrogen from the oxygen in water, so-called green hydrogen. Unfortunately, at present, this method is uneconomic and current technology is not capable of producing the quantity of cheap hydrogen required to be a viable substitute for conventional energy sources such as gas and petrol. Paderca is a blue hydrogen project, meaning that it uses hydrocarbons rather than water as the input for producing the hydrogen. Despite this, it has exactly the same emissions profile as a process using solar or wind energy to produce hydrogen, but at a fraction of the cost and much greater scale. The first planned stage at the Paderca project is to produce 300,000 tonnes of hydrogen per year, which would help to satisfy the growing Asian market for hydrogen and its derivatives like ammonia. The product would be shipped out through Darwin, which is the closest port to the Asia-Pacific market. The Paderca hydrogen project is currently undertaking a pre-feasibility study, which will allow Hexagon to assess the most viable way of building and operating the facility and related infrastructure. At the same time, the company is progressing approvals and permitting processes for the development of the project. Another key initiative currently being undertaken by the company is to enter into discussions with significant regional energy companies to explore future supply and sales arrangements for the hydrogen. Hexagon has also been heavily engaged with government agencies and departments to ensure that the project is a key player in Australia's hydrogen strategy and relevant to Australia's role as a primary supplier of hydrogen to the region. It is solutions like this, which are currently economically viable and using established technology, which will allow economies to start to make significant impact on reducing greenhouse emissions today, rather than having to wait decades for new technologies to mature and emerge to be practical in the real world. Hexagon also has other projects which are focused on future electrification of the energy and transport industries, namely the Macintosh project in Western Australia and the Ceylon project in Alabama, USA. Macintosh has graphite as well as copper and nickel, all essential materials for batteries and renewable energy infrastructure. The project is currently undergoing further exploration work to establish more information about the resources and how best to extract the minerals in the least environmental impact manner. With the Ceylon graphite project in Alabama, Hexagon is currently in discussions with potential partners in the States on how to advance that project to be able to meet the rapidly growing appetite for domestically sourced graphite in the USA. Hexagon's management team has a range of experience across battery materials, energy and renewables, with an overreaching focus on best practice ESG methods and practical solutions to solve real-world energy needs while creating value for shareholders. For people who are interested in learning about the company, I would encourage them to visit the Hexagon Energy Materials website at hexagonenergymaterials.com.au.
Hi, I'm James Graham, CEO and Managing Director of Recce Pharmaceuticals Limited. Recce Pharmaceuticals is listed on the Australian Stock Exchange and the Frankfurt Stock Exchange under ticker codes RCE and R9Q. We are an infectious disease company commercialising a new class of infectious disease products. As an infectious disease company, we really focus upon our antibacterial arm and our antiviral capabilities. We have the first new class in over 30 years as part of our antibiotics division. For our program, Recce 327, focused on sepsis, septicemia or blood poisoning, the US FDA awarded us a QIDP designation, or a Qualified Infectious Disease Product designation, which provides us 10 years market exclusivity above and beyond our patent position, government backed in the USA, plus fast track regulatory review for the life of the regulatory process. We're making our product in our Sydney manufacturing facility to phase 1 and phase 2 quality purposes, and we have a number of clinical programs working in the background. Sepsis, focused on bacterial blood poisoning, intravascular use, and topical burn work with Professor Fiona Wood out of Western Australia. So often people ask me, if I invest in your company, how do I make any money? You guys aren't making any sales. In early stage drug development, it is about getting that compound, preferably a compound with a big end market focused on an unmet medical need, closer to that market approval with the aspiration of future sales. So over the company's journey, particularly the last 12 months, our share price or capital gain position has increased around 320% in 12 months. An infectious disease company in the midst of an infectious disease crisis, it's kind of the right space to be in. Most would otherwise say, what about the dividends? Well, this isn't the company for you. Dividends are obviously a post-sales type situation. When we think of unmet medical needs, we talk about markets without price pressure. We're not playing against generics. It's currently unserviced by existing drugs. So sepsis, it's the #1 most expensive condition treated in health, double the second most. Burn wound patient population, many, many millions per year. Helicobacter pylori, well, there's big numbers in the billions spoken about there. And actually, I discovered today, 89% of gastric ulcers come from Helicobacter pylori initial infection. And of course, on a per treatment basis, expensive product, big patient population, potentially great value. So from the perspective of corporate social responsibility, it's an area of the business that we are always focused upon. Why are we focused upon it? It's the world we operate in. Our ESG, from an environmental perspective, we take a hazardous petrochemical compound or hazardous waste from the petrochemical industry. We actually take the highly active components of that, polymerize it, and create what should be a very highly valuable and certainly very useful end product. That end product from a social perspective is focused on tackling the problem of antibiotic resistance or superbugs. So the problem, of course, where bacteria mutate and antibiotics no longer work is what we're fundamentally using that hazardous previous raw material in its end form. From a governance perspective, we have independent board members. We have committees. I don't want to say committees for committee's sake. We got one for all the right things in this space, independent audits, and obviously good corporate governance associated with ASX reporting. So as a company, we're very well funded, about 20-ish million cash at bank. We've got products in near-term clinical trials, and we're thrilled to be in business.
So how is this different to existing antibiotics?
This is the first class of new antibiotics in over 30 years. All existing antibiotics to date are naturally derived. They're bacterial fungi cultivated out, put against the offending bacterial fungi. And really, if you think of it like a lock and a key, you've got the antibiotic and you've got the bacteria. The two come together with a specific mechanism, but when that bacteria mutates to survive, which it always has and it always will, it just no longer works. So we began with first principles in mind, overcoming nature's shortcomings, and we've designed ours with specific mechanisms to be attracted to the protein and interact with the protein of that bacteria regardless of its mutated form, meaning we work and we keep on working with repeated use, something antibiotics no longer do.
And what are the company's immediate priorities?
Well, we have two clinical programs working. One is our sepsis intravascular program out of Adelaide's CMAX facility. The other is led by Professor Fiona Wood and colleagues, world-leading burns expert out of Western Australia, utilising the compound on a vulnerable burns patient population. Yes, our Sepsicide is a wonderful clinical data point to come to be available later this year, but I really like what could be seen as a sign of new hope in the fight against superbugs indicated on that vulnerable burns patient population. So I want to see those data points and the global relevance that could be.
Cerulli is a global health and beauty tech business. Please observe our disclaimer in relation to forward-looking statements in this presentation. Cerulli is a health and beauty tech business, and we are growing shareholder value through the global distribution and sales of our scientifically validated, innovative consumer products, and we operate in the anti-aging and longevity space. Essentially, we are addressing a rapidly growing global market for effective, functional anti-aging products. We will make the population live longer, preferably, healthier, and looking better. We have enjoyed rapid growth since we launched our first commercial range of products in 2015, and our compound annual growth rate was around 37% until 2020. We have been affected by the pandemic, and the reason for this really is because our distribution network was fundamentally around prestige retail stores. These are bricks and mortar stores like Neiman Marcus and Bloomingdale's in the US and Priceline in Australia. Following the pandemic, we have invested heavily into our e-commerce capabilities. Our products lend themselves to e-commerce. They are subscription products, and the longer you use our products, the better you look, the better you feel, the better your hair is, the better your skin is, and the healthier you are. As a result, direct-to-consumer business is becoming very important to us, and in fact, this is where we spend and expend most of our funding. Going forward from 2022 financial year, this is definitely going to be a focus area for us, or it has been, and we have recently launched our new e-commerce platform. So what are we looking forward to in FY 2022 and beyond? Our growth pillars are three fundamental things. The first one is our expansion into China through our recently signed distribution agreements. The first one with a group called OHM, and this is for our heritage Japanese brands, Joju and Lexilis. The second one is with Aeon Group, and that is for our Evolis brand, which is our Caucasian brand. We expect that our Chinese distribution will contribute significantly for our revenue growth going forward. The second pillar in our growth strategy is our e-commerce. We have recently launched our new Australian website, much more capable for advertising and really optimizing for Google and really attracting the traffic that will actually then can be converted. This website will be replicated in the US in the near future, and later on this year, we'll be looking at Japan. And finally, we will be looking at launching new products. Our first new product, a hair growth supplement, will be coming out later on this year, and we will be looking at subsequent supplements for anti-aging, mitochondrial function improvement, energy metabolism improvement in later part of the FY 2020 financial year. As a company, we take our social, environmental, and governance responsibilities seriously. From an environmental perspective, packaging and sourcing our raw materials is the biggest impact potentially on the environment. All our packaging currently is recyclable, and we are continually looking for biodegradable options, although the technology is not quite there yet for us to be really convert our entire packaging into biodegradable. In terms of our social responsibility, we encourage diversity within our company, amongst our employees, our board, but also we look at suppliers and partners that observe internationally recognized human rights and labor practices. In terms of our governance practices, we operate our business with honesty, integrity, and transparency. And we want to make sure that our financial information is put out accurately, and we are audited every 6 months. Thank you very much.
Hello everyone, we are Bryce and Alec, co-founders of Equity Mates Media and host of two of Australia's largest investing podcasts, Equity Mates Investing Podcast and Get Started Investing. Firstly, a big shout out to the Capital Network for throwing this conference. It's exactly what Australia has needed, so we are glad to be part of it. However, my name is Bryce and this is Ren, otherwise known as Alec, and we have interviewed over 150 of Australia's and the world's greatest investors. And today we're going to spend 5 minutes going through some of the major lessons that we have learned from those interviews. So Ren, do you want to do the honours and kick it off?
Sure. So we'll kick it off with Malcolm Turnbull, the former Prime Minister of Australia. He told us to think beyond property. He lamented that too many Australians pour all their money into residential property.
Yeah.
Avoid that concentration risk, diversify, think about stocks.
Thank you, Malcolm. We interviewed Emma Fisher, who is the portfolio manager at Early Funds Management, and she said, rightfully so, that you do not need to study finance to be a great investor, and that is true. Ren and I didn't study finance, and
you're not a great investor.
And I'm not a great investor.
So the next one is probably my favourite insight. Nick Griffin, the CIO of Munro Partners, told us how it's just 4% of stocks have driven the overall return of the index historically. Just 4%. Back in the day, it was companies like Walmart, then Boeing. Think about today, it's companies like Apple, Amazon, Microsoft driving the overall return of the index. So the key skill, if you want to be a stock picker, is finding that next 4% of the market that will drive the next leg of the returns.
Love that. We spoke to Tom Cowan, who is co-founder of TDM Growth Partners. Look them up if you haven't. They are a fantastic...
or listen to our episodes with them.
Or listen to our episodes. And Tom said that people and culture is the most important thing. A stock is much more than just a 3 or 4 letter ticker, a symbol, and that you need to really do the work and invest in the right people, because at the end of the day, the business and the success of it is really about the collection of people that they employ. So do your work and check the management that are running the business.
So next up, we spoke to Mary Manning, who's the portfolio manager of Elliston Capital's Asian Growth Fund. Mary's had an unbelievable history, worked for George Soros, worked for Howard Marks, some of the best investors in history. And Mary told us how Asia is just too big to ignore. The IPO pipeline's hot at the moment. Some amazing companies are going public. There's investing opportunities galore. And as Australians, we should be thinking beyond our borders and looking at the opportunities out there.
That's it. Get out of the ASX 200. There's more out there. Turning to Hamish Douglas, CIO of Magellan Financial Group, an incredible investor here in Australia. And he said that if we're looking at the streaming wars, Netflix is going to be a $1 trillion company.
Big call.
Big call.
Do you agree?
Do I agree? I can't disagree with Hamish Douglas.
Hamish Douglas, the first billionaire we had on the show, hopefully not the last.
Hopefully not the last.
And to round it out, the 7th insight that we want to share with you guys today, we had Larry Diamond on the show, the co-founder and CEO of ZipPay, one of the hottest stocks in the Equity Mates community for 2021. He told us how he's, as a business leader, is thinking beyond Australia, is thinking long term. And we just loved that. You got to look for CEOs that are thinking like that. He did say that he wants to be the first buy now, pay later provider on Mars.
Yes.
Will he do it? Will he beat Afterpay there?
Yes, if he gets in with Elon. But those are 7 hot tips or things that we've learnt from some of the amazing experts that we've interviewed across our time here at Equity Mates. If you would like more, you can join us every week on Equity Mates or on Get Started Investing, or head to equitymates.com to find out about the other shows that we are doing. But again, thanks to the Capital Network for allowing us to be part of this conference. And Ren, we will leave it there.
Yeah, start investing if you haven't already.
Nice.
Your future self will thank you.
Hi, my name is Molly Benjamin and I'm the founder of Ladies Finance Club. We run events, workshops and membership all about helping women take control of their financial futures and to get money savvy. Now, I want to talk about the 3 things you need to check before you start investing. Now, it's very exciting getting on the investing journey and it's a great way to grow your wealth. But there's a couple of things that are really important you need to check. And I find that these come up a lot. People get excited. They're like, woo, I want to start buying. But it's really important to make sure that you have a strong financial foundation first. So the first thing we say is you've got to set up an emergency fund. What the hell is an emergency fund? So sometimes these are called runaway funds, rainy day funds. We call them OMG funds at Ladies Finance Club. And this is all about making sure you have a safety net. So we say put $1,000 in this and then 3 to 6 months worth of expenses. The best place to stick this is in a separate bank account away from your everyday spending, so you're not going to be tempted to creep into this. Now, this is such an important part of becoming financially fierce. So $1,000 and then 3 to 6 months worth of expenses. Now, oh my God funds or emergency funds are only to be used in emergencies. So going to a bar, wanting to buy shots for everyone, forgetting your partner's anniversary present, these are not emergencies funds. These are not emergencies. Your car tire blowing, global pandemics where you lose your job, these are emergencies. So again, that's 3 to 6 months worth of expenses, how much it costs to be you in an account. Because the worst thing that we don't want to happen is if you need that money fast and you've invested it, you might have to take it out when the market is not doing its best or hasn't performed well and you'll be making a loss. So that is a really important one. The next one is to pay off any high interest debt. So we're talking credit cards, personal loans, buy now, pay laters, anything with a high interest rate of over 10%. Why is this? This is because when you make returns, you're not going to be able to beat the interest rate that you're paying on a credit card, unfortunately. So if you're paying 18% on a credit card and you're making 7% return, that just ain't going to work. You're going to be going backwards. So it's so important to make sure that you pay off any bad debt. So we're not talking student loans, we're not talking mortgages, we're talking those really high interest credit cards, buy now, pay laters first. And then the next one is to use money you don't need in the next 2 to 3 years. So if you're planning on buying a house in 2 years' time, you probably wouldn't want to be investing this money because if the market does take a downturn, you might not have the time for the market to recover and you'll be, again, having to take your money out where there might be a loss. So definitely, if you're needing something, if you're trying to buy a car, a house, saving to go on holiday, you would only want to be investing money for the long term, because remember, investing is all about the long term. It's not about beating the market. It's not about day trading. It's about putting it in there for the long run and having a nice, consistent strategy. So hopefully that was helpful and you can kind of tick those 3 things off, or you've already set them up and you'll be ready. And all the best for your investing journey. It will be an exciting one, and feel free to pop in and say hi at the Ladies Finance Club. Thanks.
So Finian, can you tell me more about this concept of financially happy and why it needs to become the new metric that you believe people should be focused on?
So Lelda, traditionally in the financial industry, it's been this idea of financial freedom, and it's all about a future destination. I'll be happy when, I'll be free once I get this sort of financial position. And I discovered, after helping a lot of people get to financial freedom, after working with millennials for 13 years and building them to financial freedom, a lot of the time they got to the number and they weren't happy. And I just went, this is a disconnect. How can we be working for 10 plus years to get to somewhere and we don't actually enjoy the destination? So I realized we needed to change that and focus on the now. That's where all the magic is, in the present moment. And financially happy is that metric. It's this idea that you can be both happy and wealthy in the present moment. And a lot of it is to do with your beliefs and your thoughts and your behaviors and feelings associated with money. And I believe if more people started focusing on that, they would be making better decisions in the short term, which would end up looking after their long term anyway.
And Finian, why do you start every conversation with your money story?
So Laura, the money story is the imperative part to success. It's understanding how you have a subconscious program which was affecting your decision making. And why that's really important, because it links back to what I just shared, is a lot of people would set these goals and they get given a financial strategy, which on paper will work if you follow it. But then after a year working with an advisor, they come back and have a review and they're like, why aren't I on track? And it's because they didn't understand their money story. And the money story is affecting their behaviors, the thoughts that are coming up, and ultimately really inhibiting their success. So we get into the money story, and the money story consists of your family of origin story. So what was the conditioning that you received that has been fed into your subconscious programming from your environment? Then going through a money timeline through every 5 years of your life and saying, what do you remember most about money in that time? How did it affect you in the current place? And then we look out of that and we shake it out and go, well, here are a set of beliefs I have around money. Here are some thoughts I'm having around behaviors. This is then driving some behaviors, and then this is driving my feelings. And we work out what is in service of you and then what is being in disservice of you. And if things are not serving you, then we need to change that and rewrite your money story. And once we can do that, then we can go into the practical financial metrics.
So Finian, what are some tools that people can use to help them make better financial decisions?
So there's a large number. We've created something called the money saboteurs. We have 12 money saboteurs, which are basically a psychological assessment on what is affecting you, what's being a saboteur in your money relationship. Things like being the dependent, the child, the gambler, the irresponsible. And when we look at that, we can start assessing and seeing, this is how this is affecting my decision making. And we can start changing our behaviors to change our relationship with our money saboteur. They're always going to be there, but we can stop letting it affect us so much. So that's definitely one tool. We have a great quiz for that. Another one is the idea of the 4 yes test. So this is something you can do before you make a purchase decision. And it really helps you just to work out whether this is something that is going to add to my life or take away from my life. So the 4 questions are, first, do I have the budget? And if you don't even know what your budget is, then that's probably a tool that you need to be doing. And the important thing with a budget isn't a limiting thing for you. It actually creates freedom. It makes sure that you're spending money on things that matter for you and you have that money. So first, do I have the budget? Second, will this purchase increase my happiness? That's all about the financially happy concept. We want to be happier, not just wealthier. We want to be happier. So will this increase my happiness? Number 3, does this purchase align with my values? So once again, you need to know your values to ensure that you're putting your hard earning money into things that matter for you. And then finally, will this purchase move me closer to my intentions and goals? So if I get a yes on all 4 of them, go for it. Like literally spend it, guilt-free, enjoy it and have so much fun with it. But if you don't answer all 4, put your money away for something that you'll value more. And it won't feel like you actually feel liberated in that moment. It won't feel constrained. You'll be like, I just protected myself against one of these saboteurs. I'm going to have more choice in the future. So that's an incredible tool that I love to share with people.
And finally, where can people go to learn more about what you do?
So the greatest place to go is to financiallyhappy.com. We have an education platform there. We have digital programs, which is really exciting because previously I'd worked with boutique clients. I had a boutique business, which meant that our philosophy could only get to so many people. And we've got an Australian financial services license, which is great. We're all qualified advisors. But now through these digital programs, I'm able to get the philosophy out to the masses. And I'm really excited about that because everyone needs this and everyone should have the right to access this. And I'm super excited what's happening in Australia right now. We've just partnered with a very large institution, and this will be being rolled out to over 1 million people over the next year.
Hi, Leldy, and thanks for having me. And before I start, some important information. This is general advice. Obviously, investors' circumstances have not been taken into account. So at a high level, Domicon has 2 key business lines. The first is fractional investing. As the name suggests, it's taking lumpy assets and dividing it into bite-sized chunks. The majority of the assets are properties, for example. So instead of buying the whole property, investors can buy bits of property. So it's a modern form of syndication. The other aspect of our business is really the flip side of that coin, is people who own a whole house to be able to sell a bit of their house, and that's called fractional equity release. In fact, the product's called senior equity release. Domicom is a B2B business, so we don't really market direct to consumer, and we go through financial advisors, affinity groups, and affinity groups are things like property developers, wind farms, solar farms, where they need community engagement. And then we have a couple of B2C clients. The first is a group called Halo, or Australian Stock Report Wealth. Another one is a latest Islamic finance company called Crescent Finance, who are in the process of launching their product. So that's really our business model. As indicated earlier on, in terms of products, it's fractional investing, equity release, but also lending as well. So we enable some of our investors, or our clients, to enable investors to access high returns by syndicating the loans. In other words, cutting the bank out. And so it's a very attractive product, particularly in this environment where the interest rates are so low for term deposits. So yeah, now the focus of today is really ESG and and what Domicom does from an environmental, social, and governance perspective. So from an environmental perspective, we have some of our clients interested in particularly rural, and in the future going forward, the production of food is clearly in a sustainable manner, clearly a very important investment class. And so we have several rural investment property investments already, and also options on the platform. The other is the obvious one, renewables, and solar, wind farm, batteries, biofuels. And Domicom has already had their first indication in supporting a major wind farm called the Sapphire Wind Farm up north. We've got several other transactions in the process of supporting solar farms and wind farms as well. And we've also had a go at a biohub, and I'm sure we'll get that going again, particularly with the focus on hydrogen coming forward. So, and then the other side of social investment would be NDIS. There's clearly a great need in Australia to provide accommodation that's fit for purpose for the disabled among us, and particularly a lot of families are getting older and they're worried about what's going to happen to their children. So we've already had our first 2 syndications in this area, and it creates a very attractive investment for investors in terms of the yields are quite attractive, and they're backed by a government NDIS program. So you're talking about 8 to 8.5% income yield, and you're delivering a social outcome. You're creating accommodation for people who need it most. Now, that's really an attractive investment class, and we've got maybe another dozen of these indications lining up. So we believe going forward, this will be a major opportunity. And then the other side of socially is affordable housing. We all know it. It's harder and harder to get accommodation, and the need in Australia is in the hundreds of thousands of homes needed to accommodate people. And what we're doing is really partnering with what's called a community housing provider and the National Housing Finance Investment Corporation to be able to access low-cost government debt to deliver discounted rent for essential workers. That's our initial target. So nurses, police, firefighters, and etc. And but there's a twist. The normal affordable housing just gives people 25% discounted rent. Our product delivers that, plus we give equity. So in other words, the teacher or the nurse or the firefighter or the policeman, they get equity in the apartment they're renting, 1% per year for 5 years. So we give them a head start onto the property ladder, in addition to giving them access to discounted rent. And one additional feature of our product is that the nurse or teacher or the essential worker can choose the subject, the suburb that they wish. Yeah. So in summary, Domicom allows people to basically invest in fractions of specific assets, primarily properties, but not just properties, and to deliver an outcome for either their environmental objectives, social objectives, or governance objectives. So thank you very much.
Geffen, it's a digital marketplace platform for enterprises and agent networks. We are serving industries that sell complex products. I'm talking about selling insurance, finance, real estate, etc., where the human expertise, human advice, and human touch is needed in the sales process. And that's the reason corporates sell those products and services through agent networks. This world of selling complex products is suffering from an inability to evolve due to several reasons. The corporates have legacy systems which are complicated to transform to digital, and their salespeople, the agents, are not digital experts, nor they have the resources or knowledge to acquire such expertise. With the regulation involved, everything must be compliant and controlled. And that's exactly the niche we target and disrupt. We've developed a unique digital platform for both enterprises and the agents. We empower global enterprises to deliver consistent and compliant business methodology, messaging, marketing, and sales to the agents. At the same time, we enable the agents to digitally increase their productivity and performance with their relationship with the customers. We are working today with global leading corporations and a growing number of agent networks. As a platform, as a digital marketplace, we generate revenues from several revenue streams. Subscription license fees charged from corporations, transaction-based fees charged from the corporations as a commission of the transactions that are generated within the platform. Advertising solution fees, opening up an ability for agents to advertise on large scale, supporting regulation requirements. Processing fees for processing online payments within the platform. We've quadrupled our revenues in 2020 to over $16.4 million with a strong growth momentum. Digital transformation is not a new concept. It has accelerated since COVID in many industries as agents, salespeople had to continue to do sales, but with remote abilities using digital channels. Geffen's approach embraces environmental, society, and governance with our commitment to implement as a public company, applicable to both Australian and Israeli laws. A commitment to delivering policies and procedures with openness and integrity, with implemented diversity policy, ensuring the best person for the job is employed with equal opportunities for all. Our vision, our platform stands out to solve inequality. The fast-growing inequality divide between those with access to capital and those with only their labor to offer is something we can, and attempt to impact. Today's access to cutting-edge technology is limited to those with capital. It is one of the key factors to inequality. It is why the owners of enterprises get ever richer, while the people working for them, distributing their produce, are pressed for efficiency and long hours with restricting rewards. Geffen technology transfers the power to the distributors. It takes enterprise-grade capabilities and empowers the people. Hidden from sight and requiring no learning curve, it makes them more efficient without any investment of capital and brings their core strength, a human being in touch with customers, to the foreground. It frees time and enables their hard-earned relationship to become capital, not a cause for more labor. If the social utopia is providing universal basic income to everyone, freeing our time from work to be utilized as we choose, the foundation of this society is in utilizing the resources and technology humanity achieved without requiring labor. We are working hard with deliberate steps to achieve this dream. At Geffen, we see a strong network effect that helps the platform to evolve and grow. Each corporate brings to the platform its agent network, and each agent brings to the platform his or her respective customers. The more it grows, the more benefits for everyone. It's scalable, results-driven in both sales and operational levels. The platform could be adapted to dozens of sectors, representing millions of agents and thousands of corporations. We record strong customer engagement, outstanding customer satisfaction rate of 8.54 out of 10, and a constant growing number of customers joining our platform every day. Thank you.
Good afternoon. My name is Raymond Shorrocks. I'm Executive Chairman of Auteco Minerals, an asset which is based in Canada and Ontario. There are 4 things you need to take away from this particular presentation today. One is the location we operate in. That's a tier 1 location. I'll take you through that. The second one itself is the asset at Pickle Crow that we own. We own about 500 square kilometres, of tenure, and I'll take you through that. That's the gift that keeps on giving. There's plenty of upside with respect to this particular asset, and we also have the corporate team and the balance sheet to pull this deal off. Let me just go back for a second to the location. You would always hear people talk about a tier 1 location. Now let me talk about Ontario, Canada, and what it's done for us in the last year and a half since we've had this asset. We've got 4 rigs turning at the moment, and the accessibility to go to 6 rigs is there for us. So it's getting harder and harder to get rigs, but we do have 4 rigs turning and another 2 to come. Secondly, we have great access to the Mishigogaman, the First Nations group that we have to deal with in the land in which we occupy. And from my point of view, we have a great relationship there. The other thing is the turnaround times in assays is around about 18 days. If you're talking about Sweden, in which some of my other companies operate, or Western Australia, it's up to 8 weeks. So that's why it's a tier 1 location, and it's a mining friendly jurisdiction. The next thing is the asset itself, Pickle Crow, located in Ontario, Canada. The infrastructure is fabulous there. So it's a short air flight from Toronto to Thunder Bay to Pickle Lake Airport, and then it's a 10-minute drive on sealed roads to Pickle Crow, the site itself. So we have sealed roads throughout, and we can drill all year round, which is really, really important. This Pickle Crow asset has a long history of high-grade gold mining. It operated between 1933 and 1965 and produced 1.5 million ounces at a stunning 16 grams per tonne. It closed in 1966, not due to a lack of mineralisation, but importantly because gold had dropped to $35 an ounce. You can see with the current gold price, there's a lot of upside for us there. And let me talk about this upside. So just on Wednesday this week, we announced our latest drill results, some of which are the most stellar results we've seen thus far. So currently the asset is 1 million ounces at, again, a stellar second best grade in Australia at the moment of 11.3 grams per tonne. And these latest results show, and which are all outside that resource, that when we do our resource upgrade, which will be in the first or second week of July, which is a short 3 or 4 weeks away, we will be substantially increasing that resource. So we have a lot of upside in this asset.
Thank you very much for having me today. My name is Sachin Goklani. I'm the Chief Commercial Officer of PayGroup. We've been listed on the stock exchange for just about 3 years now, and it's been a wonderful journey, and I'd love to tell the investor network about us. So who is PayGroup? At a glance, PayGroup looks after your mission control, payroll, and HR needs. But what does that practically mean? So payroll to the core is so important to organizations. And because of our geographical spread across 41 countries, we're able to provide that mission critical, fully compliant solution of payroll to our customer base and their employees in those jurisdictions. We have a great track record with over 2,100 customers, means we are very trusted by our clients and our clients' employees. And once we get to the core payroll, we then help our customers digitize their HR back office by offering a module of HR suite services like onboarding and timesheets, which I'll come to shortly. And that's how we help our customer base. And our recognition is very important to us. And that's where Gartner recognizes us, as well as other organizations, in their multi-country payroll guide. So that's a glance of PayGroup. Now, what does PayGroup actually provide its customers is it gives, as I mentioned, the core of payroll, which is mission critical to every organization. But we also help our customers, and it's been a real journey in the last 18 months with the uptake of people wanting to get onto cloud platforms and digitize their back office. So we also have modules which speak to, as I mentioned, onboarding, timesheeting, give leave workflows, expense management. And we've also introduced to help our customers through the COVID environment, keeping their workplaces safe by introducing facial recognition and temperature checks to make sure that their employees are safe. Our growth's been great. We measure our growth through number of pay slips we produce. And we've, since listing, grown our business by 10x in pay slips in our geographies and over our client base. Our record results are a true indication of how we value our business, as well as how we look after our shareholders. Top line growth is fantastic, where we've achieved record ARR. We've also looked after our margins, because that's very important to us and our shareholders. And we've achieved our first positive EBITDA since listing, and we're very proud of that. And the driver for our growth really is in the sales growth we've had. And through COVID, we've been able to help more and more companies digitize. And we're going to continue that growth potential by increasing our ARR and keeping a great eye on our margins. The future looks bright for us. The future looks bright because we are helping more companies digitize. We are helping more companies grow into geographies. We are very well positioned for organic growth because we've got a great direct sales channel, but we also have wonderful partners who welcome us into their family. And some of those partners who are global companies don't have the presence that Pay Group has in Asia Pacific. So where they sign a global deal, we are their chosen partner in Asia Pacific to help them implement and operate those payroll and HCM solutions for their clients. We also introduce employee well-being by looking at how we can help our clients' employees and our own employees take advantage of these new themes in the world, like on-demand pay and financial education. So we'll bring them into our suite. But we also very focused, given our DNA of core and process and payroll, to help us and our clients automate. And it's a big project that we've got underway to automate a lot of our internal processes, to implement faster, to introduce automation in our payroll processing, which not only helps us deliver faster, but actually helps our clients get a better view of their workforce globally. And we'll continue to update the market on that. What excites us about Pay Group is how we continue to grow with our customers, and we continue to grow with our customers' employees. We provide mission control services. We're going to continue to do that, but expand our geographies as our clients grow. And with that expansion comes not just making more revenue and making more margins, but looking after our employees and our clients' employees. And that's where, when Pay Group talks about being the trusted partner or trusted employer, we really mean that. We want organizations to choose Pay Group as their number one core payroll partner and number one HR partner globally. And we want to make it a great place for people to be employed at.
Jess, why did you start sharing content on TikTok, and what do you think that your audience loves about your content?
Yeah, so I really started sharing content on TikTok because personal finance has always been a hobby and a passion of mine. But it wasn't until I actually graduated from my doctorate program that I realized how little financial literacy actually kind of permeates throughout our education system, at least here in the States. So when I started working in my field, I was having conversations regularly with other doctorate trained professionals about how to get car insurance, how to buy a house, what's the process for applying for a mortgage. And I realized then that you can really be the most talented, hardworking, intelligent person and still not have a clue about personal finance. So, learning that only 26% of women in the United States actually invest money in the stock market for me was just so eye-opening. And I really felt like I needed to get involved and contribute to the growing wealth of free information that's available on the internet for people to get started. So I love to educate. I love to have that conversation with my viewers that really anybody can be an investor. All it takes is some initiative and the drive to educate yourself. And learning about investing is completely free, but it's truly the difference between retiring with nothing and retiring a millionaire. And all you have to do is get started. So I think that my audience loves that we can have these honest conversations in a genuine and not at all condescending way, so that everybody of all experience levels can be actively involved in the conversation and know that they can take control of their own financial future.
So can you go through what some of your most memorable content has been?
Definitely. So I started off posting on TikTok, and that's the platform that I actually have the most followers. So I've got about 170,000 followers on TikTok at this point, which is kind of crazy because I only started my channel like 8 or 9 weeks ago. So it's been kind of a wild ride. And so in order to expand on my content further, because, you know, TikTok is just 60-second clips, then I came out with my YouTube channel, which is the same name, Ecom Jess. So I've been doing longer videos on there talking about, you know, the content in a little bit more detail. And then of course I have my Instagram with the same name, Ecom Jess, where I just post like little snippets of things and some kind of blog style posts over there as well. And I think some of my most memorable content really has been a lot of it around real estate. Like a lot of people like to learn about how to apply for a mortgage, how to get a low interest rate on a mortgage, how to put less than 20% down on a house. So that was something I think with the housing market being so crazy, at least here in the States at the moment, I think is content that's really resonated with people, especially because the home buying process can just be so complicated, I think, and people are very nervous about buying a house and how to get started. So I was able to share my experiences with the process of home buying. I've done it a couple times now. So I talked about that a little bit. And then I think the other thing that people really like is when I kind of go into like the nuances and the details about investing. So talking about capital gains tax with traditional investments and also cryptocurrency and just the little small details that I think people tend to kind of gloss over in normal conversation, but giving it kind of a highlight in those 60-second clips.
And finally, Jess, where do you look for content inspiration?
Yeah, so to be honest, I think content inspiration is all around us. As a scientist, I'm always asking questions about why the world is the way it is. You know, how are people doing that? What do I need to do in order to be able to do that? So I draw inspiration from my colleagues, from my friends, and even my own financial experiences over the years. But I also draw massive amounts of inspiration from incredibly strong and powerful women that I've been lucky enough to surround myself with over the years, who have built their own personal empires from the ground up, you know, achieving financial freedom, establishing businesses, running real estate brokerages. So the long and short of it is that I really draw inspiration from everywhere.
So what did you think was missing in the investment industry when you created Sharesies, and how did it drive you to find a solution?
Yeah, so we started Sharesies 4 years ago, and there was 6 founders about that helped create Sharesies. And at that time, there was a lot around rising house prices and low interest rates and, a real feeling like people couldn't get ahead with their money if it was in the bank or they couldn't get a home, and we really wanted to find a way where people could feel like they could get ahead and build their wealth over time. And you looked around and we did heaps of research and found 99.5% of people want to be an investor. Like they really wanted to be able to feel like they could get ahead with their money. And it was really, it felt really ambitious and also really hard because there were 3 key barriers that were facing a lot of people 4 years ago, which was like they felt priced out, like you needed heaps of money to get started, jargoned out, like you needed a degree in finance just to understand, investing or what to invest in, and then essentially left out, like felt like, oh, maybe it's just for the wealthy few and it's only set up for them and not really an inclusive space where more people can build their confidence with investing, even if they are new to investing or seasoned investors. There's always room to learn and grow. And so we really set out to remove those barriers, and that's what we've done.
And what problems do you believe investors have had in the past that you're finding solutions for now?
If we go back to those problems I talked about, I guess around like priced out, that's why we've made sure that there's no minimum investment on our platform. So literally people can invest with amounts that they want to and not needing to worry about having to figure out how much a whole share is and what that means in their portfolio. And that was also important to us because we wanted to create a platform where people could build wealth over time and also feel and learn feel like an investor and learn more as they go. And so that was really important. We do heaps of educational content and make it really fun and light, from podcasts to every 3 days we do a newsletter of what's happening in the market, and just really removing a lot of that jargon, but helping people get those insights in a digestible way. And then, working really hard to make sure that we're building a platform that is for as many people as possible and more inclusive than, say, just exclusive, which has been in the past.
So what do you see as the future for investment, and what opportunities are there for investors to capture?
Oh, there's so much opportunity. I think, it's a real range of getting access to investing. On our platform, we offer access to the Australian Stock Exchange, 4 US exchanges, and also the New Zealand Stock Exchange. And being able to track that in one place is pretty exciting, and seeing how your portfolio can grow and shape from there. I think in the future, we're seeing a big what's really exciting is as more people become shareholders and own companies or own funds, they actually start to have more of a voice and a say in these businesses, and these businesses need to care for their shareholders and their stakeholders. And so it'll be really interesting to see where the future of business goes as more and more people become owners of businesses and funds, and you can see a sustainable change may start happening, which is great.
My name's Aaron, I'm CEO of Connection Telematics. We're a profitable ASX-listed enterprise-grade software company that services the US automotive software market. We have 2 proprietary software platforms, OnTrack and CXZ Track. Each of those incorporates telemetry, reporting, analytics, and contract management. The platforms are used primarily for fleet management purposes, used by OEMs and dealers. So in the US, we're very fortunate to have over 1 in 5 franchise dealers trusting us and our software platform to manage their courtesy fleets. Looking at slide 2, our operating model is quite an elegant one. So it consists of 3 components. So we have embed, integrate, and generate. Those coincidentally are sort of operate in chronological order as well. So our real background is in creating software for a specific customer and embedding ourselves further and further into their daily work lives. And so that's something that we've been doing for quite a few years now, with our cornerstone customer being General Motors. The next step of the process is to then integrate ourselves into the software ecosystem. So for dealers in the US, a key piece of software is called a dealer management system, or DMS. And so that's one area of integration that we've begun and we're continually working on. And the other is to integrate with other software providers that have complementary functionality to ours that is of use to our dealer users. And the third component is generating data insights. So we're in a very fortunate position in that, as our software is used by approximately 4,000 dealers in the States to manage billions of dollars worth of vehicles, there's a considerable amount of data that flows through the platform each year. There are over 2 million loan contracts per annum. And so there's a considerable information advantage that we're building over time, and there are a number of ways that we'll be able to commercialize that. From an ESG perspective, one of the things that really motivates us internally is the understanding that on average, worldwide, passenger vehicles spend approximately 95% of the time sitting idle. So we have an asset being a vehicle that has a significant carbon footprint, and it's sitting idle 95% of the time. So if we can improve the utilization of that asset, that's both better for the asset owner, which could be a dealer or even a consumer, and it's also better for the environment because you need fewer assets to generate the same output. So when we're looking at our software specifically, we support 4 key trends impacting the automotive industry over time, and those are the shift to online retailing, the adoption of electric vehicles, the adoption of shared mobility services, and then finally, the most speculative one being the adoption of autonomous vehicles over time. So if we take a look at the right-hand side of of this slide here. We benefit from quite an efficient distribution model in that we can sell to the OEM. Our software is then used by the dealers, and then it helps the dealers to interact with their consumers. So as a consumer, when you walk into a dealership with, say, a 2010 Chevy that you need to get serviced, they will present you with a loaner car to drive around for a few days. And so our software enables that functionality and allows you as a consumer to have a really good experience. So you can arrive at the dealership, the dealer already knows that, you know, who you are and why you're there. They already have your courtesy car ready for you. It's an appropriate model. So if you're handing in an SUV, they're not going to give you a hatchback. And all, you know, the paperwork, etc., is all digital. And so as a consumer, you have a really good experience. So that's what we do, and that's that's a little bit about us.
BPH Energy is a listed public company and is a major shareholder in Advent Energy. Advent Energy has an 85, it controls the PEP 11 permit and has an 85% interest in that permit. BPH has a 22% interest and has the capacity to go to 33% in Advent Energy. Advent in turn has the only petroleum permit or gas-prone permit on the entire eastern seaboard, and it has a potential for both solving the gas supply crisis in New South Wales and also for carbon capture and storage, and I'll speak to that in a moment. There is a shortfall of gas predicted into the New South Wales gas supply network, forecast from 2023 through to 2025, and Advent and in turn BPH can play a key role in that. Advent supports a net zero objective by 2050, and the company can play a direct role in achieving that target. The offshore Sydney Basin offers the potential for carbon capture and storage through the storage component of that element. CCS is recognised by the International Energy Agency and the Intergovernmental Panel on Climate Change as having with CCS to play an essential role in meeting global emission reduction targets. And the Sydney Basin is recognised as contributing 1/3, the onshore Sydney Basin is contributing 1/3 of all of Australia's greenhouse gas emissions. And so finding and developing a suitable site offshore for that storage will become a key part of meeting Australia's carbon reduction emission targets. In the drilling of the Baleen well offshore Newcastle, subject to approval by NOPTA and NOPSEMA, Advent is looking to create two substantial value accretion areas. That is in supplying gas into the New South Wales and Eastern Seaboard market, and by providing a geosequestration or carbon storage area. Those elements of those objectives will give substantial value accretion to both Advent and BPH Energy.
So we're Frontier Digital Ventures. We're based in Kuala Lumpur in Malaysia. Our business model is about investing in online classifieds in emerging markets and evolving that model to allow consumers to complete the transaction of houses or cars on the internet. So if you can imagine countries in Southeast Asia, which we have a large presence in, or LATAM, very, very difficult for consumers to find a house or a car online. And that's problems being solved and is not unusual. But the real challenge is how do we help consumers actually go through the entire process of buying the house and buying the car. So if you could imagine going to an REA or a car sales, rather than just completing the search, you actually stay in that environment, in a trusted environment, and you connect with the seller. It's facilitated by the portal, and we help you go through the entire transaction process. So our global footprint has been focused on 2.5 regions, Latin America, so the LATAM countries, and what we call developing Asia, which essentially is Asia ex China and India. So we go after markets like Philippines, like Sri Lanka, like Pakistan. And in South America, it's not about Brazil or Argentina, it's about Colombia and Chile and other markets like that. And we're in some MENA markets as well. So we're very focused on those regions, and we're very active in seeking out new investment opportunities. And we really look for market leaders in their desired field. And we tend to look for local entrepreneurs who often have left their home country, they've gone away, they've studied in a third country, and they've seen some mature examples of these businesses. They go back to their home country, they do a startup, and that's the sort of business we like to invest in. So we're always looking at key regions in emerging markets, but moreover, we want to look for market leaders, early stage opportunities where we think we can add value in concert with the founder. Business model's really familiar because most people will have engaged with it at one point in time, which is to make the process of finding a house or a car easy. And we know that that product exists and that problem has largely been solved in many markets. The interesting thing about our business model is we see that as the beginning, and we see that really as a platform to allow consumers to stay in a trusted environment in an emerging market. And you'd appreciate in emerging markets, there are trust deficits in how people buy and sell things. Our aim is to build a trusted environment by way of a classifieds platform, but then to enable the consumer to stay in that environment, to connect with a vetted seller and be able to transact goods easy and safely and conveniently on the internet with a third party sponsoring the process. And that really comes back to fulfilling not just the search and discovery phase of a house or a car, but the entire transaction of a house or a car within that digital environment. When we listed at IPO, we were significantly smaller than we are today. Our revenues totaled less than $4 million. Our Q1 revenue in 2021 was $11 million. So if you annualize that over the course of this calendar year, it's going to be a minimum of $44 to $45 million. And we certainly hope to have a 5 in front of that number. So we've grown almost 10 times since we listed. And that really has been looking for clear market leaders in the sort of businesses we like, working with them to execute a plan around building a critical mass as far as online marketplaces are concerned. But moreover, our long play has always been about creating a foundation and environment to facilitate transactions. And that's where a lot of the economic value is in our portfolio. And if I were to roll the clock forward 3 to 5 years, that is absolutely our ambition, is to have most of our revenue coming from facilitation of transactions. The ESG values in emerging markets is really an important element for us, because we're investing in such early stage businesses, and we feel that we've got an opportunity to really embed some behaviors and some emphasis on things that are important to us. As you'd appreciate, gender diversity or gender equality in our markets is something that is not a high priority, and we put a huge priority on it. In fact, we don't regard gender equality just as an equal number of men and women in the workplace. It's about equal opportunity and equal reward. And to the extent that we're creating digital platforms, we're trying to make a process that was wholly physical, involved a lot of energy and involved a lot of moving around, into something that is far faster and something that is far easier and can be expedited kind of without leaving home. And that's certainly big areas of focus for us. And to the extent that we are a listed company, we think we have the gold standard in terms of how we operate our business practices, and trying to embed that into emerging markets is a big challenge, but we see it as a big opportunity as well. I'll just finish by saying that we're a business that has learned its trade in Australia. We've moved overseas to base ourselves, and we're investing in many, many markets, taking a lot of the expertise that we've learned over the years into new markets. We think it's a really cool story. We think that the next 3 to 5 years are really exciting. And we're really bullish about what we can build in terms of a market leader, a global market leader in our field.
So thanks very much for the opportunity to present regards DeLorean Corporation Limited. DeLorean Corporation is a fully integrated deliverer of renewable energy, infrastructure and electricity retailer. So we've been established about 8 years with the setup of the Jandakot bioenergy plant in Western Australia which has been commissioned for a number of years. But we've since grown out the business to be a business that has EPC contracts for the build of bioenergy plants, as well as a retail business in Western Australia that has licenses to move into the national energy market. And we've got projects under construction for third parties in Australia and New Zealand, as well as our own projects that we're building in most states of Australia. The DeLorean Corporation comprises a group of 3 companies, each of which vertically integrates for the delivery of all of this infrastructure under the one roof. So Biogas Renewables is an EPC and O&M contractor, both for ourselves and others. DeLorean Energy is the project developer, so it takes projects from a glint in the eye through to development approval and financial investment decision. And Clean Tech Energy is the energy retail company that enables us to monetize the energy, the renewable energy from our portfolio of renewable products. We're an early entry opportunity for investors. We've got fast growth. We've had very fast growth over the years, and transitioning to infrastructure, we're the opportunity now to be a major ESG player in Australia that's presenting renewable energy infrastructure and retail across the country. We've got strong tailwinds with shifts in policy around waste management and energy. And we're particularly strong in positioning for biomethane, which has got very, very fast demand now as the fossil fuel companies and pipeline operators transition to decarbonise what has fundamentally and traditionally been a non-renewable source of fuel. We're in 2 markets. We're in the organic waste collection and waste management market, but we're also in the renewable energy market, both of which have got substantial support from a government policy perspective. And we get paid to take our fuel. So there's a national policy to halve the amount of organics going to landfill in Australia, and that'll be promulgated through the states by 2030. So there's this pent-up demand for disposable organics, and we're a fantastic pathway to deliver that, recycle it into energy. We essentially collect organics from the domestic and commercial sector, including food organics, garden organics from the council bin. We put it through a mature technology process and deliver electricity, heat, or natural gas. Natural gas is important because we can deliver biomethane at mains gas quality, which is in high demand, obviously, from the gas networks, but also hungry gas users because they had no other pathway to decarbonise other than hydrogen, which is in transition and still a number of years away from a commercial perspective. So we've got projects across Australia, one already built and commissioned, one just in commissioning now, 2 shovel ready, 1 in build, and we're delivering a project in New Zealand as well. So we've got a pipeline of about $80 million worth of projects, which we're looking to then unpack into a $200 million portfolio. Just to articulate what these plants look like, a couple of examples of projects we're working on. Blue Lake Milling is in Bordertown, South Australia. We're just finishing the build and first gas. It's taking the mill husk from a milling operation, turning that into renewable electricity and heat, and essentially taking the mill off the grid and exporting electricity to the grid for surplus. The EcoGas project referenced in this slide is taking food organics from the Auckland City Council and will deliver heat and power for a major greenhouse operation south of Auckland. In terms of the projects we're delivering ourselves, the DeLorean Energy Victoria 1 project has reached FID. We're now moving into build for that as a result of the IPO. It's taking commercial industrial waste streams around the Shepparton area in Victoria, delivering power into the grid. Co-located at a piggery, which will take piggery effluent as well to deliver energy. And the DeLorean Energy SA1 project is a project that we've acquired 100% of. It will be one of the first green gas to mains projects in Australia under an offtake to Origin Energy going through to AGIG. So that'll be a major milestone, not just within the sector, but also more widely in its mainstream news. The business has had a 5-year profit history, backed off retained earnings. We're heading towards, we forecast an EBITDA in the prospectus, and we're materially on track for that EBITDA this year. And the forecasts for next year are looking really solid, well beyond that. And we've got the expectation of high growth in revenue and high growth in EBITDA, transitioning our business to annuity-based income streams from free cash flow from those infrastructure projects, with a view to becoming a price earnings and dividend yielding business in the future.
Michael, you are a founder, chairman, and CEO of a NASDAQ-listed company, yet an advocate for Bitcoin. Many would say stocks are investing in real assets, while Bitcoin is purely speculative. Can you see why many hold this view, and why do you disagree?
Well, stocks represent equity in a company. So there are thousands and thousands of companies, and they all have their own risk. Will the product work? Will the service work? Will the CEO be good? Will the board of directors exercise corporate governance? So those are equity investments. Bitcoin is digital property and it's on an open monetary network. So the idea of Bitcoin is we'd like an immutable, immortal ledger. I want to keep track of 21 million coins in cyberspace that are divisible by 100 million Satoshis each. So 2.1 quadrillion Satoshis. We want to keep track of it for 1,000 years. And we don't want to rely on a company or a country or a CEO or a management team or an individual server. That's the basic problem is accounting that Cerulli came up with around 1400 something. And accounting is how we run the world. The problem with accounting is it's on paper and people can create two sets of books and you never know whether or not the accounting is proper. And eventually some government can require by law that you change the books. And so Bitcoin is triple entry accounting. If double entry accounting was the thing that made modern economics possible, Bitcoin is triple entry accounting, which means that you write the copy of the books every 10 minutes on the blockchain, and it's impossible for anyone to change them.
Now, Michael, critics of Bitcoin will say one of the biggest misleading statements of cryptocurrency is that you invest in it, with many believing it's purely speculation, no different to a lottery ticket or taking advantage of investor psychology. What do you say to those who say Bitcoin is pure speculation with no intrinsic value?
I would say that mathematics and calculus has intrinsic value and double entry accounting has intrinsic value. So triple entry accounting has even more intrinsic value. If I'm speculating, I'm just buying a lottery ticket and hoping I'll win. What I'm doing with Bitcoin is I'm acquiring, if I buy one Bitcoin, I'm buying 1/21 millionth of cyber Manhattan. If Manhattan was made up of 21 million blocks and sitting in cyberspace, then each one of them is a Bitcoin.
MicroStrategy is the first publicly traded company to invest significant treasury assets in Bitcoin. Given you continue to add to your stockpiles, what's your 1, 5, and 10-year price outlook for Bitcoin?
I can't give you an exact price forecast for 1, 5, and 10 years, but I do think, I expect that first it will approach the market cap of gold, which is 10 trillion, that's 10x more. And then I think it will begin to just gradually replace monetary indexes like the S&P index and bond indexes. And so there's no reason why it can't creep up to 20 trillion and 50 trillion and 100 trillion as we inflate the money supply and as it replaces these other assets as a store of value for institutional investors and corporations and governments.
So how did you get involved investing and why did you start sharing content online?
Firstly, so my partner, he was heavily involved in that. He's been trading for more than 20 years and he's known in the Australia fintech industry, on Twitter as well, that he's really good at trading and also he's got a firm. And so I learned technical analysis through him. And after that, you have to do your own homework. You can't just rely on someone to tell you what to buy. That's just me. So after that, I get to ask him how it works to meet brokers, like how do you network with people, who do I speak to get deals, and eventually I got my 708 certificate, and from there I was able to get allocations and IPOs, and I get to meet my own brokers. So I created my own network, and I actually encourage every woman to do that yourself, to be fully independent. And someone can only open the door for you, but you have to walk in yourself.
So what are your preferred investments now, and how do you decide between stocks and crypto?
I would still trade crypto personally because I can catch something that goes up to 200 and 2,000% like overnight. It's insane. Like, how can I go from there and go back to stocks where it probably like maximum go up to like 100%, and that's probably like once a blue moon. And in crypto world, it happens almost every night, really. But obviously, you need to know when to get in, when to get out. But stocks at the moment, like commodities, gold, silver, I still trade them, but rarely. I don't trade them on the computer like that. I take deals, I do placements, I do IPOs, and like deal flows come to me. But when it comes to trading, I'm still waiting for crypto to kind of consolidate to reshape again, then I'll get in.
Now, Eunice, investing is about risks and rewards. How do you consider the risks, and what is your advice to investors who might be starting out?
If you're starting out, I always like to tell people, especially my friends and family, which I care about, I tell them to invest in something that is safer. So in the stocks world, that's safer. So I would say go to the IPO. This looks safer. So that's where you can put a bit of money, let it grow. And after that, when you have more capital to play with, you gain confidence, right? And after the confidence you've gained, then you get into maybe a bit high risk trading. I don't like to tell people to get straight into crypto because it is a high risk and reward arena. Like, I personally got scammed a couple of times, like in shitcoins. But when you got the right one, you make a lot. I got moves up to like 2,000%, 25 to 20 bags over like 3 days. But I also got coins that doesn't work, and my money's just gone, $10,000 like that, like in seconds, right? So that's what I'll say to people. Always put something into something that you feel like you can lose. And then maybe consider something like crypto, but you just have to kind of learn how to trade first before you get into it. Don't listen to what people say, because people just tell you what they bought, so then you can help them increase their profits. Always do your own research. That's all I can say.
So Justin, why did you start sharing financial content online, and where have you found your biggest audience?
Yeah, good question. It's a big one to unpack. For me, I started at the start of 2020. So obviously we were faced with COVID, and I work in the aviation industry as my 9-to-5 job. So at the end of March, early April, I was presented with a letter, and it says you're stood down. You're essentially not going to be working for 6 months. And I was like, we're in a bit of a pickle here. And I've always loved YouTube. I've loved watching personal finance content, invested for 4 years before that. And I was like, you know what? This has presented a really great opportunity to jump on YouTube, make videos, and try and inspire a younger generation of investors out there. So that's what I did. I was locked in my apartment because we couldn't go anywhere, and I just made video on top of video and got a pretty good reaction from people out there. And that just kept driving me to continue to make videos and inspire young investors. I think, I'm 25 here, so I'm still learning along with my subscribers. So that's great to share that journey. And essentially make some of the same mistakes that my subscribers are making, but learn from that, share from that, and grow. So I think that's just been the key thing, is just engaging with all the audience out there and seeing the big community that you can build. So that's who's given me my inspiration. That's where I drew it all from. But look, on the outside of that, I watch all the big finance creators all over YouTube from in America and here in Australia, which really drive me to make content. I'm like, look, hey, if they're doing it, I can do it too. And a year and a half later, we're still going strong. So I'm pretty proud of that.
So Justin, what content does your audience enjoy the most? And can you give me an example of what's received awesome engagement for you?
Yeah, I think the best content that I've made so far is really beginner introductory content into investing, because I just take myself back to when I was 19 trying to get started investing. I was like, what in the world is going on here? So the more simple I can make it, the more engaging it's been. So a couple of my videos have had, 20,000, 50,000, even 100,000 views. And to me, it's very basic, and, I'd skip over the video, but to a certain audience, find great value in that content. And they really relate to that because it's educational and informative. So yeah, things such as online broker tutorials, breaking down some jargon when it comes to investing, some ETF breakdowns, really basic stuff, but it's really valuable to investors looking to get into the market.
That's fantastic. And Justin, where do you find inspiration for your work?
Oh, that's a tough question. There's so many different things. I mean, I see a lot of great content creators on YouTube and in the podcast world that I draw a lot of inspiration from. But I think the biggest, inspiration that I get is just from the subscribers in my Discord. They reach out to me. They're like, hey, look, loved your video. Can we get your thoughts on, X, Y, Z? And I'm like, yeah, of course you can. And I create a video about that. So if it wasn't for everybody who watched my stuff, I wouldn't be doing this in the end. So yeah, I think everybody who stumbles along the channel, I'm have to thank very much because they're my biggest inspiration.
Awesome. And you mentioned new investors. What are your biggest tips for investors starting out?
As cliche as it sounds, it's very cliche, right? I'm going to have to hit you with a cliche one, but it's just get started investing. I think the hardest thing to do from my personal experience, like it took me 1 year to make my first investment just because I was so nervous with the process and so just like terrified to make it. But as soon as I made my first investment, just this massive weight got lifted off my shoulders. So look, I know, so many people say, just get started, so easy. And I can feel your pain, how it is quite difficult, but really break it down, start entry level, watch a few online broker tutorials, learn about potentially ETFs or your favorite companies, and just go for it, because that's the only thing you have to lose is not investing, I think. And if you make a mistake, the way I look at it is, it's a learning curve. You're going to get better. You're not going to make it again. And trust me, I've made many mistakes, and probably a lot of investors out there have too. And we're a completely different person from it. So get started. Don't procrastinate. Put that phone down, get into it, and get started investing.
Great to hear. And finally, Justin, where can people go to find your work?
Yeah, I make YouTube videos predominantly. So if you just search my name, Justin Baldori, on YouTube, you can't miss it. I'm the only person that pops up in that space. So that's where I make my content. But I also have Instagram and TikTok. That's just off the side, keeps me busy. But yeah, YouTube for all things investing and personal finance for the young generation.
Hi guys, my name is Amy Nicole Marietta. Thank you for having me today. I'm really excited to be here. So I'm going to be talking about investing in cryptocurrency, two things I am very passionate about because they don't teach you this in school, and I think that this is so important. So I made a whole PowerPoint and I'm just gonna kind of go through that and explain everything to you. Okay, so on this first slide, I'm just kind of talking about how the ultimate goal is to create passive income and make your money work for you. Diversify your portfolio, whether that's in real estate, stocks, crypto, etc. Try and create 7 streams of income. Use the internet to your advantage because there's so much you can learn on the internet. Now we're going to get into the future of cryptocurrency. Okay, so what is cryptocurrency? Cryptocurrency is decentralized digital money based on blockchain technology. We've all heard of the original cryptocurrency, Bitcoin. Bitcoin is the original, created by Satoshi Nakamoto in 2009. Every other type of cryptocurrency is referred to as an altcoin. Altcoins are just alternate cryptocurrencies that were created after Bitcoin. Then you'll hear the term meme coins or shitcoins. Meme and shitcoins refer to cryptocurrencies with little to no value, but that doesn't mean you should dismiss them. They are digital currencies that have no immediate discernible purpose. However, take Dogecoin for example, that is now going to be able to be used as a currency. So sometimes meme or shitcoins can have some type of value. I also put this graphic here on Bitcoin and just kind of explaining the fundamentals of it. Okay, now we're going to talk about the advantages of crypto. There are so many. First, we have much lower fees for transactions. And then we have much faster, almost instant transaction times compared to banks or trading stocks on most platforms. 24-hour accessibility. You can access your crypto anytime. Whereas with stocks, you can only trade when the market is open. The crypto market is always open. Next is decentralization. Most cryptocurrencies are decentralized, which means there's no third party involved, no banks, no governments, etc. Cryptocurrencies are typically designed to be free from government control and manipulation. Huge difference. Decentralized platforms give access to financial systems so that more people who may not have access to traditional financial products can. So this will create a more fair world. Next is the safe blockchain technology. The blockchain technology is a system of recording information in a way that makes it difficult or almost impossible to change, hack, or cheat the system. A blockchain is essentially a digital ledger of transactions that is duplicated and distributed across the entire network of computer systems on the blockchain. Another huge benefit of cryptocurrency is you can stake your crypto for passive income. Yes. Yes, love passive income. So the process of actively participating in transaction validation, similar to mining, which is a whole other thing you can look into, on a proof of stake blockchain. On these blockchains, anyone with a minimum required balance of a specific cryptocurrency can validate transactions and earn staking rewards. And then I also included a graphic here just explaining the difference between Bitcoin and fiat money. And on the next slide, I just have a graph of blockchain technology kind of explaining it. I kind of already went over all this, but just take a look. Yeah, we love the graphs, at least my visual learners out there. And then here's another graph. How does Bitcoin work? Kind of explains it here. It's a peer-to-peer network, worldwide decentralization. Okay, now we're going to talk about the top crypto coins. So these are the top cryptocurrencies with the highest market cap, which means it has the most money in them. So we have Bitcoin, BTC. I just put their symbols next to them. Ethereum, Binance, and Cardano. And then some shitcoin meme coins that did well the past 6 months are Dogecoin, SafeMoon, and Shiba. But these are more volatile and you just have to be careful and really watch those prices, but it can be much higher returns on those. Next is platforms to buy and store your crypto. So we have Coinbase, KuCoin, Binance, Trust Wallet, Voyager, PayPal, or Ledger Wallet, which is a physical wallet that you can buy to store your crypto offline. It's like a USB. And then I'm gonna go over other tools to use. So these tools have been really helpful for me, and I think they'll be really useful for you guys too. So let's get into it. First, we have the coinmarketcal.com website for crypto news. This is really helpful just to see what's going on with different coins, if they have any major events going up, etc. And then we have Coin Tracker app, which helps keep track of all your crypto wallet profits in one place. So you can see how your portfolio is doing. You can link all the different accounts. It's amazing. And then we have CoinMarketCap, which is also an app, and it helps you stay on top of coin prices and set phone alerts for those various coin prices. Let's talk about the future of cryptocurrency. Rapid global adoption with major credit card companies, platforms such as PayPal, Square, Cash App, and even banks. El Salvador just made Bitcoin legal tender, which is huge. Then we have things to look out for. Make sure to store all of your passwords in a safe place, because if you lose it, you're pretty much screwed. Beware of rug pulls, which has previously happened with meme coins. Always make sure to do research on the team behind the projects, because some say they're anonymous and sometimes that can be sketch. Just do your research. Lastly, have an exit plan when you reach certain goals. Just have some type of plan. If you want to learn more, you can follow me on my social media outlets, so YouTube, TikTok, Instagram. Thank you guys so much for having me. Investing is so important. Cryptocurrency is the future. Go look into it and don't wait. Don't be a late adopter. Okay, thank you guys.
Hi, I'm Lee Travers, and I get to represent DigitalX as the only ASX company creating blue sky investment opportunities for both our clients and customers, as well as our shareholders. We have exposure to both digital assets and blockchain technologies. Our businesses provide shareholders exposure to the price appreciation of digital assets and the potential earnings from DigitalX's expanding suite of governance-enhancing RegTech products, which is led by Drawbridge, which was launched in late 2020. Our customers in these digital asset investment funds get exposure to the new age stores of value without many of the risks associated with directly investing in digital assets. And our customers for Drawbridge receive reduced risks and protected reputations, which help them to avoid any reputational issues from insider trading, as well as protect and enhance the integrity of publicly listed markets. Our investment thesis around digital assets is very strong. We see millennials as being the biggest investment demographic into the market at the moment. And just in 2020, they have ticked over as the highest generating or income generating generation, which means they're going to make more investments. And then we see that transitioning of wealth from baby boomers down into the hands of millennials happening, which is forecast to be around $68 trillion by 2030. So that's a huge amount of capital going into those that are investing in this sector. That's going to happen over the next decade. Institutions, well, they entered the market in 2020, and that's been really important to help change the investment narrative around speculative investment to long-term store of value. And that's fantastic, whether that's public companies in the US, whether that's global investment banks, or even some of the proposed ETFs that are coming to market. These are all going to be huge drivers of demand coming over the next decade or so. And certainly in response to some of the QE or financial instability events that I've seen in my short career in the digital asset markets, whether that's Brexit, whether that's the Cyprus bail-in, these sorts of events that keep happening keep leading to increasing demand for Bitcoin and digital assets as that digital store of value that's outside the current sort of financial markets frameworks. So I think with those continuing to come and forecast to increase, the future for digital assets from that perspective looks really strong. And then finally, on sort of DeFi, NFTs, and the digital future, that's really the biggest theme that's coming through. And what we certainly know is over the last sort of 25 years, the value in markets of intangible assets. So that's intellectual property, that is companies' brands and their reputations. That is now encompassing around 85% of the total market cap of the largest global companies. Whereas that number back in 1985 was around 30%. So a huge increase there in the value of digital, the value of brands, and that's certainly a theme that our investors are exposed to. So for Drawbridge, the initial target market is the ASX's 2,200 public companies, but the vision for the product is to be the governance standard for the world's 630,000 publicly listed companies. This roadmap, it really starts with the securities trading policies, but we see it expanding much further than that. We're currently one of the first applications on the ASX's blockchain development environment, and we're seeing a major theme of standardization of reporting around a whole range of ESG issues. So we're looking at ways that we might be able to provide a digital audit trail to enhance those initiatives. DigitalX has a focus on ESG in terms of ensuring companies adhere to their corporate governance principles and can attest to those with a digital audit trail. Our funds management business for investors helps them invest in this fast-growing sector while also managing a number of the governance issues around investing in digital assets directly. On the clean energy side of things, DigitalX actually operated a geothermal Bitcoin mine from 2014 to 2016. We're pleased to see the growing use of renewable energy to support the Bitcoin mining initiatives. And then finally, from a social point of view, Bitcoin and digital assets actually help bring financial inclusion to those that are currently locked out of financial markets. We saw El Salvador recently adopt Bitcoin as legal tender. I see that as the first domino that's fallen and a big trend to continue. The opportunity for DigitalX's growth is very significant over the coming years, and we're well funded to execute on that. So thank you for listening in.
Hello, I'm Alison Gaines. I'm the newly appointed independent chair of Hire Me Limited. Hire Me is a recruitment company driven by technology. I'm a 15-year veteran of international executive recruitment, very committed to best practice in recruitment. We have two businesses. Hire Me is a recruitment business, and we have a full service contracting business called On Contractor. Combined, the recruitment and labour hire industry in Australia is worth $40 billion. It's an interesting industry because it's very fragmented across very many small operators. Most of them don't have the capability to invest in technology in the way that Hire Me can. Hire Me is looking at disrupting the sector. We understand that one of the big challenges in the heated labour market that we see ahead of us is that conventional recruitment processes are very slow. So the analogue approach, which is very labour intensive, often takes 10 weeks. In that time, both the client and competitive candidates can become very frustrated. We're looking to put into place AI and machine learning that allows for a faster process, a cheaper process, and one that is more likely to be accurate in its matching of the talent with the employer's needs. So we are taking advantage too of the changes that COVID brought to the recruitment sector, where people, both candidates and employers, are much more comfortable using technology to meet and to match skills. So HireMe has been around for 3 years, and in that time we have been able to build a good client base, and obviously we've built labour hire deployments, and we have got people used to working with us using our AI and machine learning capability. Our plans are to spend time refining the AI and machine learning, and also investing in business development. That business development will focus on building the best relationships with our existing client base and also extending our client base. Over time, building a SaaS model, and that SaaS model will be available to employers to use in-house as a recruitment tool. So HireMe listed in 2021, we're a contemporary Australian listed company, and like all Australian listed companies, we have to focus on ESG. We're very committed to ESG, and we've identified 3 themes where we want to be particularly effective. The first is to make sure that we are operating as a well-governed entity with a good risk management framework. We have got a sophisticated board, and we are putting efforts into being a sophisticated, nevertheless small cap company. We also see as 2 other critical themes for the sort of work that HireMe does are firstly to ensure that the design of our machine learning avoids the unconscious bias that can creep into machine learning and undermine the diversity agenda of our clients. So we will keep a very fair weather eye to any unconscious bias that inadvertently creeps into our model. Secondly, we're very keen to work with good clients, and by that we mean clients who offer particularly safe working environments for our deployed contractors. So those are the ESG themes that we focus on. There are others, but those are the ones we're keeping a fair eye on at the moment.
Hi, I'm Mike Widlow, Managing Director at Biomaterial Limited. My pleasure to tell you a little bit about our really unique company. We're on a mission to create registered treatments for patients who have found that nothing else is really working for them. And we do that by bringing together some really unique assets and infrastructure. The first, at the foundation of our company, is really our medical network. We operate 7 centres around Australia currently, and to date we've seen more than 4,000 patients with unmet needs, and they represent children as young as 2, patients as old as 96, and they come with more than 40 different complicated medical conditions. In our clinics, we spend a lot of time with every patient because what we're trying to gather from them is clinical evidence of what's working or what's not. And so the brains of our company is really our data asset and the technology that we've developed to support that. That data then gives us insights into what's working and for whom, and that supports the drug registration programs and treatment development programs that we've launched. And to date, we've got 3 programs which are underway: a CBD over-the-counter medicine for mental health concerns. We have a CBD and THC medication for irritable bowel syndrome. And we also have a really unique program in place looking at MDMA-assisted therapy for patients with post-traumatic stress disorder, which really showcases the importance of our clinical infrastructure, the need for supportive care teams, and the use of novel treatments to support patients with major unmet needs. And our focus is on taking those treatments through the formal registration pathways globally. And I'll explain why that's so important. If you look at all the excitement around medicinal cannabis, for example, the industry kind of has cheered itself for getting to a point of 100,000 scripts over the last 12 months. But let's have a look at that in context. Let's have a look at how many prescriptions are written for mainstream antidepressants every year. Almost 29 million. If I was to give you the pain medication numbers, it's around 23 million prescriptions. We also get excited about saying there are now nearly 400 authorized prescribers for medicinal cannabis. but there are 42,000 prescribing general practitioners in the community. And so these numbers, and even look more extreme if we compare and lift our sights to other overseas markets, these numbers show that we are nowhere near reaching the patients who might need these treatments with something like medicinal cannabis. And the reason for that is there are no registered treatments. And so what we're committed to doing is, if something looks promising and it looks like it works, we are committed to taking those treatments through the formal registration process so that they can become mainstream and routinely prescribed treatments for those who need them most. And I'll tell you, our commitment to ESG starts with the people, very much focused in on the patient at heart. Here's the story of Bob, very typical of the kinds of people that we see at our clinical service subsidiary, Emerald Clinics. Bob was a Vietnam veteran, suffered for many, many years with chronic pain, and was on all the opioid medications and the novel pain treatments as well, with really poor quality of life. And over 6 months of individualized care, we were able to not only reduce all his opiates, in fact, he ceased all of his opiate medication, we were able to make a substantial difference to his quality of life as well. And so we're also about taking the lessons that we've learned from patients like Bob and making sure that many patients can benefit from the same kinds of individualized care. And here's this terrific analysis we did recently with IQVIA, where we looked at all the opioid medications that patients were taking in the 12 months before they saw our clinic. And we can see that very little change, steady consumption across those patient groups. And then in 12 months of care with our doctors, we're able to make a substantial reduction in that opioid demand, which leads to massive quality of life improvements, societal benefit, and of course, big differences for those patients. So this is the journey that we're on. We're just getting started. We have a long pipeline of treatments. As I mentioned, 40 different clinical indications that we're treating across our clinical network. Each one represents an opportunity for our business. And we've got this terrific team with great experience in clinical development, data, tech, and innovation to make it happen.
Jess, you're a market analyst and the ASX keeps hitting record highs. What factors do you think are pushing the market higher, and how long is this rally going to last?
Well, great question. Well, the Aussie economy is growing stronger than expected. So it's growing or set to grow at 5% this year. That's according to the RBA. And this is supporting share market growth. So I guess if you pin it down to two major factors that are driving markets higher, it's really employment growth and changing behaviours of how we're spending our money. As for how long this is expected to last, well, there's more people in jobs, there's people borrowing more, so borrowing rates are at a record all-time high, saving rates are at a historical high as well. So as long as employment continues in this upward trajectory, we're expecting this notion to continue. And also keep in mind that July is historically quite a bullish month. So it's also important, I guess, to reflect on the longer term factors and the longer term trends that say that markets historically have risen over time. So I guess with this in mind, I'll just leave you with a thought. If you invested, say, $10,000 30 years ago, perhaps maybe your parents did that for you. But look, if you forked out $10,000 into the market in 1990, and then you pulled it out last year in April 2020, you would have pulled out $114,000. So I guess, the market moves in cycles. There's downturns and there's rallies. But the really important takeaway here is if you were to sell in those major falls, there was 2 bear markets. If you sold in those technical downturns, you would have crystallized your losses and sold at possibly the worst time and missed out on the recovery. So remember, there's a lot to be said about being a long-term investor.
Now, Jess, can you give me an example of sectors that are poised to go well in the future and maybe a stock you think is positioned to benefit as a result?
So I'll say 2, tech and food and agriculture. So thinking about technology, the tech sector is set to be really supercharged for 2 key reasons. Firstly, the US government recently announced that they're spending a record $250 billion on the US tech sector, really to compete with China and Asia. So given the US wants to become the world's biggest semiconductor manufacturer, they'll be making electronic circuits for computers, phones, electric cars, driverless cars even. And the second catalyst for tech that will drive the tech sector higher is demand. So we know demand is likely to grow for technology, particularly given that 30 countries around the world plan to be carbon neutral. So semiconductors will be needed because they're, of course, a key component in electric vehicles. As for how to capitalize on this, Lelda, there's $50 billion being spent on US semiconductor firms and also attracting foreign firms to open in the US. So if you think about the ASX companies like Altium, that could be tapped on the shoulder, that might be worth your while doing your research there. So Altium, for instance, ALU, they already have facilities in the US. So they make, for those that don't know, they make the microchip boards that are inside Dell computers and some Microsoft PCs as well. And they also have circuit boards that go into coffee machines. So ALU shares, they've had a pretty good run this year. They're actually up 30% this month on the back of a takeover offer. They later rejected that. Most brokers are actually bullish on Altium, so expecting their shares to move higher. However, a bit of caution here. Altium has already flagged that they could potentially miss their revenue target. So just keep that in mind.
And finally, Jess, could you give me an example of stocks you think that will perform well in the longer term?
Okay, I guess if you're looking for undervalued businesses and prepared to be patient and invest for the longer term, you could invest in technology and utilities. And the reason that I say that is because both of those sectors are underwater this year. So thinking about tech, Afterpay is perhaps worth a look. It's the biggest tech stock in Australia, dubbed to be the world leader in buy now, pay later. So last year, Afterpay shares had a cracking year, up 300%. This year, they fell from $160, getting as low as half of that. But they're tipped to see a rebound. Why? Because Afterpay is set to launch a new app to compete with the banks. And this is touted to double their revenue and also boost their brand presence. So this will be a huge win for Afterpay. Morgan Stanley, for instance, is quite bullish on the back of this, expecting Afterpay shares to get to $145. But if you just are looking for stocks, if you just think about the key drivers of stocks, that should set you up well. So look for earnings growth and companies that are in strong growing industries.
So Scott, what are your top stock picks for 2021? And can you tell me why?
I think it's really important as an investor to make sure you are riding the wave of the future. Now, for young people, I don't have to tell you, the future is coming, the future is here, and you guys are going to be inventing it. But there are some businesses that I think are going to do really, really well, largely because, by the way, of what you're doing as consumers and what your friends and colleagues are doing as consumers and investors. Let's go with the first one. The first one is Aussie Broadband. Now, telcos are old, they're boring, they're staid, there's not much growth in the industry, except if you're a new disruptor, an innovator with a brand new culture, you're doing things a little bit differently, and you are bringing the love. Aussie Broadband, ABB is the code, is a business that is absolutely creating an immense amount of love among consumers. I've been on Twitter before saying, look, Telstra's giving me the irrits, and frankly, I'm trying to get Telstra to do something, by the way. In the meantime, I have dozens of people say, hey, have you tried Aussie Broadband? It's great, you should try it. When a boring telco can get that sign of customer love, that's a really, really good sign. They're new, they're innovative, they don't have the legacy culture, the legacy assets, the legacy way of doing business of the big guys, the old guys. When you get to start from scratch, and if you hit escape velocity, you can do really, really well. So that's Aussie Broadband, ABB. The second one is a stock that is an ETF, an exchange traded fund. They're all the rage these days, and for very, very good reason. I love low cost, broad-based, index-based ETFs. This one is a NASDAQ-based ETF. NDQ is the code on the ASX. Why NASDAQ? These are the businesses that are, and it sounds like a horrible, boring marketing line, but it's true. They are literally inventing the future. Think about Google, Apple, Facebook, Tesla, Netflix. I can roll another dozen on top of that. MongoDB. There are so many of these businesses that are literally inventing the future. These are the growth businesses of today. And frankly, either them or the upstarts in the same index are going to be the ones that are creating innovation of tomorrow. Again, we know how well they're doing this. By the way, most of these businesses are growing revenues at 20% plus a year. Even when you're the size of Amazon or Google or Apple, just a phenomenal track record. And I think a lot of promise. It gives you international exposure. It gives you diversification by industry, not as many tech stocks here, great currency diversification. And as I said, some of the very, very best businesses of our time. All right, let's go to the third one, Kogan.com. Something of an Amazon imitator. They don't even mind that, by the way. They're a bit chuffed to be compared to Amazon. This is a business that's really struggled over the past 6 months share price wise. And they had a bit of a hiccup because they had too much inventory. They made a bet. Will sales keep growing at the same rate just in case we'll order some stock? Well, they didn't, because we kind of went back to the shops a little bit, got stuck with a whole lot of stock. The market freaked out. This is a $27 stock in November last year. Now just over $10. I own shares in this one, by the way, as I do in the NASDAQ Beta Shares ETF. So I want to be really clear about that. But Kogan, code KGN, is a business I think is going to be more relevant to more people in the future. And if you think about as an investor, you want growth businesses, you're looking for businesses that are more relevant to more people more often. Now, I don't know about you. I'm certainly ordering more from Kogan. My friends and colleagues are ordering more from Kogan. This is a business that is going to keep growing. 3 million of us on their database, by the way. I think it's a long-term growth story. If it is, they will recover from the inventory problems. They will continue to grow. And if and when they do, I think the share price will be a whole lot higher. So I like Kogan. That's KGN. I think it is a business that with Amazon, by the way, I don't have to beat Amazon to do well. Amazon will probably win the Australian race. Kogan will probably be a good number 2. That's a great place to be, I reckon, if you're a Kogan shareholder, as am I. All right, let's go to RPM Global. This is a business you probably haven't heard of. It's a company that does mining software, which sounds incredibly boring, but it's really, really important because, hey, if you're going to dig a new mine or operate one, you're going to want to know what's going on underground, what you're planning to do, how you're planning to do it. That's what RPM Global does. Now, it's a relatively small niche business in a relatively big industry, but it's a really, really mission critical piece of software. Here's the good news, by the way. You guys know software as a service, right? That's the idea of paying monthly or yearly for access to a piece of cloud software. It wasn't the case only 10 years ago. I'm a little bit older than that. I remember the good old days when you had to download them on a floppy disk and whack them in your computer. That was a while ago. These days, software as a service is all the rage. RPM is going from a perpetual license, which is sell it once, use it forever, to a, hey, I'll charge you monthly or yearly for access. And that's a remarkably profitable, remarkably successful business model. RPM's in that valley between high levels of perpetual sales and high levels of ongoing software as a service sale. Right now, they're in the valley between those two because you're not making really big ticket sales, so you're losing that. You're not yet getting everyone on software as a service. You haven't got there yet. You're in between. The market hasn't yet cottoned on to the change, at least not in the price. That makes RPM Global a really, really attractive long-term business proposition as and when it makes that transition. All right, let's go to company number 5. I like a glass of wine. Maybe you like a glass of wine. Treasury Wine Estates is the granddaddy of Australian wine companies. It houses Penfolds, Wynns, Lindemans, among others. If you don't drink it yourself, I guarantee you someone in your household or someone in your street does. Plenty of us do. I'm guilty as charged. It's having a really, really tough time recently because it got booted out of China. Well, not exactly, but tariffs of 175%. Will do that if you're a winemaker. How do you sell your wine when it costs almost 3 times as much as it used to? Very tough. Their sales are at about 97% in China. Like Kogan, the short-term issues there have really hit the share price. By the way, like Kogan, I also own shares of Treasury. It's hit the share price really, really hard. Now, here's the thing. They have managed to find growth in the US and Europe and Australia when they've, funnily enough, changed their focus. And the good news is, I think the China story will recover. And if and when they get back into China, that share price should go back up as well. That's Treasury Wine Estates, TWE.
Roger, how long have you been investing in stocks, and why do you think they provide a compelling investment to new investors?
I started investing in the market when I was at university. So that was 1989, 1990. So a long time ago, 30 something years ago. And I it's compelling because I've worked in futures, I've traded derivatives, I've traded everything across the globe, commodities, the whole lot. And the great thing about stocks is they give you an invitation, or they provide an invitation to invest in businesses. If you look at the AFR Rich 200, the list of those people are comprised largely of people who have businesses. So as a wealth creation platform, a business is probably the best way to go. And stocks are pieces of businesses. Now, not everybody treats the stock market that way. Some people treat the stock market the same way they might a casino, and they just bet on things that go up and down. That's not what we do. We buy pieces of businesses, and over the long run, it works really, really well. If you can identify a quality business and you can work out the right price to pay, then you will become wealthy given enough time.
So, Roger, what are your thoughts about cryptocurrency when it comes to investments, and how does it compare to stocks?
Well, I don't class them as an investment. I think they're more speculative. Having said that, though, I'm open to the idea of having some cryptocurrency exposure in my own portfolio because I have sympathy for both views. I have sympathy for the view that it's a bubble and it's going to burst. And I also have sympathy for the view that Bitcoin will never be a universal currency. And there is understanding the financial system gives you an immediate appreciation that will never happen. Bitcoin will never become a universal currency. However, I've got a lot of sympathy for the view that there is a disruptive element to the blockchain and it has significant potential. And if currencies associated with particular projects on particular blockchains are successful, then those currencies could be very successful too. So I've got sympathy for both views, but I don't consider it as an investment the way I would a piece of a business.
Roger, when it comes to successful investments, can you tell me perhaps about some of your biggest achievements?
Sure. A very large investment I made at the inception of our Montgomery Small Companies Fund, which is run by Gary Rollo and Dominic Rose. That particular fund has turned out to be one of the best performing small companies funds in Australia since inception, which is awesome. Gary and Dom have a very different approach to investing to me, still focused on quality, still focused on prospects, but they understand market sentiment really, really well. And that allows them to understand catalysts better than some investors who are more traditional or more conventional. And so that investment has been very, very successful. Outside of our own funds, I made a very, very significant investment in the Australian Unity Healthcare Property Trust. Sounds super, super boring, but it's delivered about 15% per annum for the last 5 years. And it's done that with virtually zero volatility on the downside. So even through the GFC, it didn't go down at all. To have an investment that's almost as stable and safe and secure as a term deposit that generates 15% is pretty exciting.
And finally, Roger, looking ahead, which sectors or stocks should investors be putting their money in your opinion?
Yeah, look, I think there are some structural growth companies in Australia that are going to do super well. Companies like Macquarie Telecom, Unity Wireless, both of those businesses are structural growth stories. Then there's the sort of residential and leisure caravan park and residential living or village operator called Ingenia. And then if we reopen, we all get vaccinated and international borders come down and we get traveling again, businesses like Webjet, Corporate Travel Management, they're going to do super well too.
So Angie, can you tell me, why did you start investing?
Great question. So I started investing because I used to run a business, like an accounting software business that I used to set up, MYOB accounting software. And then when they listed in 99, I bought shares in the IPO for $2 and they went up to $20. So it was my first sort of taste of these like high flying sort of companies during the sort of the whole boom. And it just sort of got me quite interested in share investing.
And Angie, what kind of stocks excite you?
Yeah, well, the stocks that sort of excite me, I think, are the micro cap, real sort of small cap stocks that not many people are following, that I can do some really fantastic research on. So I like stocks that I think are just going to go up 10 times. Like they've just got I can see a lot of opportunity, like what happened with the MYOB stock, that I could just see, it could really, really take off. And because this is my only source of income, I'm quite highly motivated to do really well and make a good return. So stocks that sort of excite me are definitely stocks like like a company that's got really sort of unique competitive advantage, and just ones that have got this like real gusty tailwinds that sort of, pushing the business along. Like one that excited me very early on, I suppose, was Afterpay. Like my hairdresser wouldn't stop talking to me about Afterpay and telling me how much her girlfriends totally loved it. So that was before they listed, and I saw in the AFR that they listed. So I bought into Afterpay just after it listed. And that was a stock that really excited me at the time. I could really see that this was just going to do really, really well.
So Angie, how do you conduct research into stocks? And can you give me an example of your research that's actually reaped rewards?
So I like to try the product and service if I can. I definitely like to, go out to the store, if it's a store, and talk to the staff, buy the product, get my friends to buy the product and tell me what they think. So things like that, like I'll connect with the management on LinkedIn, I'll connect with staff, competitors, I'll ask crazy questions on LinkedIn to people. And I'll watch all their videos, like I'll watch YouTube videos of presentations that the management have done, or even I like to connect with the product development people, because if it's a software product, I want to see them do a demo of the product and talk about it, maybe at a trade show rather than an investment seminar. So sometimes these are recorded, so you can watch a YouTube video of them presenting to their potential customers. So it's more from the business point of view, like and things like researching, like say with Redbubble, which has been one of the really great investments, because I got into that sort of about 70 cents. So I got in really early for that. And I set up a Redbubble shop, and I put some of my daughter's artwork on cups and T-shirts and pencil cases and things, because I sort of wanted to research the company from an artist point of view and from a customer point of view, and to understand the platform. So that's been one of my really, really great investments this year. I actually sold out quite a bit in December, so just a tiny bit. But I researched on things like Trustpilot, like I want to see sort of what ratings the company's got, and Glassdoor, just to see if employees like working there and what do they think about the management. So that's lots of sort of research. Definitely research in terms of web traffic. Like I want to know if the web traffic for the website's going up or down. That's a great way of researching stock. But I read the financial reports. I'm an accountant, so I'm a CPA. So I definitely go through all the financial reports and look at who's buying and who's selling the stock.
So Angie, what's your advice to new investors that are getting started in stock investing?
Okay, great question. Well, I put it down because I have probably lots of investors, so I tried to sort of narrow it down to like seven points. I said the first one, definitely read Peter Lynch's One Up on Wall Street, which I know a lot of people recommend, but I read it a couple of times, read it a couple of times a year. Like, don't just read it once. And what I think for new investors is really study that legs story in the book about there was these little plastic eggs where they were selling. Haynes decided to sell stockings in these little plastic eggs. And, they trialled it in the local town that Peter Lynch luckily lived in. And luckily his wife went out and bought the stockings and the plastic eggs. So it's a fantastic story. And I'd love sort of new investors to really sort of understand that story, because that's what we're trying to look for. We're trying to look for legs. So read that. Subscribe to the AFR online. You can even get a subscription if you're a student subscription to the AFR online. So read that. My third one was get on LinkedIn, and happy for you to link in with me. So you can, find that way you can link into all the people in the companies that you're researching, so you can follow their LinkedIn feed. So that's a good one. I think surround yourself with positive people. So that's why I love you girls. You're very positive people. So Surround yourself with very positive people. Number 6, I said join an investment group or create an investment group. And you've met some of the wonderful people in my investment group, Helen and Peter, and I just absolutely adore my investment group. There's 6 of us. We actually met at a microcap investment conference in October 17. So, and we just chat all day on a little WhatsApp group, and we share lots of information, and we really motivate each other and attend events together, which makes attending events a bit of fun, and we follow each other's stocks. And I just think it's such a great thing. And number 7, I said, work out what return you want to get from your share trading and who you're going to share that return with and what you're going to use to calculate this return. And I use ShareSite. And I think that's a really great way to keep us accountable to make sure we're doing really well.
And Angie, what's your favourite stock at the moment?
My favourite stock at the moment, like my sort of conservative stock that I like to pick is Accent Group, AX1. I love Accent Group. It's one of my biggest positions, and they just bought Glue Store, and they bought lots of online businesses and distribution rights when they bought Glue Store. So check out Accent Group.
So my name's Stuart Dixon. I'm the Managing Director and CEO of Variscan Mines. Variscan Mines is an ASX-listed company interested in exploring and developing high-quality base metal, industrial metal assets, and to bring them ultimately into production to serve metal for the global needs. We're very excited to have collated together a high-impact portfolio of assets, predominantly in Spain, but we also have interests in Chile and Australia as well. In Spain, we're delighted to be advancing 2 really high-grade zinc assets. And zinc's really interesting at the moment. It's performing really well, and it's absolutely vital to our economy and the world we live in. It's often overlooked as a metal. It's actually the 4th most used metal in the world, and that's a $40 billion industry. And you touch it every day, you use it every day, and you don't even realize. And so it's performing well. And it's vital to not only the growth and health of people, but also our future and our future energy needs. It's some really interesting technology advancements going on here in terms of zinc air batteries. It's vital to a circular economy in that it's 100% recyclable. So 60% of all the zinc ever produced is still being used today. So we think we've got a metal which is vital to our everyday, it's vital to our future. It's performing well in price. And now I'm going to take a deep dive into the assets themselves. Our lead project is the Navales Udias zinc project in the north of Spain. It's in the province of Cantabria, and it's centered around a former historic mining ore field. And this was an ore field which was developed by Asturiana de Zinc, which was later acquired by Xstrata, which is a company that most people will be familiar with. It's located 9 kilometers from the Riocin mine, which closed in 2003 and is a world-class mine by any measure, 62 million tons at 8.9% zinc and 1% lead. That closed in 2003. We're next door, and they used to refer to San Jose mine, which is part of our project, as Riocin's little brother. And we always think as San Jose as Riocin's twin brother. And that's really what we're about to embark on, is developing a former producing mine into a much larger producing mine of the future. We've done a lot of exploration and development work, collating a lot of historic data, 90,000 meters worth of historic drilling data we've compiled very efficiently. And that gives us a head start in how we plan to develop and commercialize our asset. We've taken the next step by drilling, and we've been delighted to produce some extremely eye-catching drilling results with extremely high grades. And that's really the hallmark of our project, high grade zinc, which is over a 9-kilometer mineralized trend. And we believe that we have 2 opportunities here to, 1, develop, bring San Jose back into production quickly. It's a former producing asset. And 2, develop a resource of regional and possibly even global significance akin to Riocin that I mentioned earlier. And how can we do that? How can we achieve our objectives? Well, actually, it's really simple. Because it's a former producing mine, we have a lot of the infrastructure in place. So we have sealed roads to our mine site. We have mine development completed. We have water and power already on site, mains grid connections. And we also have routes to market. We are 80 kilometers away from the San Juan smelter owned by Glencore, which is the world's second largest smelter. So we're really excited. We think we've got all the component parts to take an established, proven mining jurisdiction and bring it into production for today and tomorrow. So as a company, Veriscan Mines is committed to ESG, and we layer ESG on everything that we do. And just some examples that we've done: we've engaged with the local universities. We have interns participating in our project, and we believe this is a project and ultimately a mine which should benefit all in an environmentally responsible way, in a socially responsible way. And we believe, with good governance overarching that the link between ESG and shareholder value is clear for everybody's benefit.
Rapala Resources is an ASX-listed junior mining company. We have an exciting portfolio covering both development in Spain and also exploration in Canada. And what we particularly like about our portfolio is that it is exposed to a number of commodities that are all doing extremely well in the market and are recognized as having a very bright future. They all are either critical metals or they're metals that are going to benefit from the changing technology that we see in the economies. So our portfolio covers tungsten in Spain, which is a development project. And then in Canada, we look at nickel, copper, cobalt, silver. So a wonderful spread of commodities and also a wonderful spread of projects for such a small company, where we have development to near-term production, and then we also have high-impact exploration. So a quick look at Santa Comba, which is in northwest Spain. That is a development project. It is one that we picked up. It's operated in the past in the 1980s. It's got a good resource, both underground and at surface. We've just completed a drilling program to expand the overall project. We've run economics on this project already in a pre-feasibility study. That pre-feasibility study shows that it is highly, highly profitable, very strong margins, even at the lower prices that we saw earlier in the year. When we rerun these numbers, which we expect to do in the next couple of months, we should see a significant increase in the overall size of the project. So we're really excited about that and looking forward to getting that release out. The drilling campaign that we just completed has been very, very successful, with some very, very high intercepts of tungsten. The Canadian properties also continue to deliver from an excitement perspective. We're going back into the Yukon to look at our copper cobalt opportunity there this summer. We've just been told that we get funding from the Yukon government to support that. And in addition, we have our high-grade nickel copper project in northern Quebec, where we've just completed a number of surveys where we're going to finalize drill targets. So that's an exciting program ahead for us as well. With respect to ESG, we are a company that's dedicated to good corporate citizenship and responsibility, no more so than in northern Spain, where there is a lot of scrutiny in Spain on the environmental aspects, and we're very conscious that we need to deliver a project that is compliant, but actually more than compliant. We want to actually give back to the community. So this is a project that employed over 4,000 people in the past when it was operating. We won't be employing quite so many, but we will be looking to employ around 40 people when this is up and running. That's very important in a region that has 12.4% unemployment. We have good support from the mayor and even the opposition party as well, supportive in the local region. We're looking to reestablish native species in the plants when we eventually rehabilitate this, and even look at some innovative ways to use the site to the benefit of the community going forward, such as a hydro pump storage facility, for example. In terms of taking the company through and making money, well, our PFS showed that this is a project that has 120% IRR post-tax, based on old commodity prices and on a smaller scale project. So we expect this to grow and become really quite exciting. We'll be producing, on latest numbers, probably close to $30 million US dollars per annum in revenues. This is near term. We expect to be in production early 2022. And so this is something that really we're moving rapidly to, that we will monetize, and we shall see the benefits of those cash flows coming to the company to help fund our high impact exploration in Canada and elsewhere. In the short term, shareholders can look forward to an updated mineral resource estimate following our drilling campaign. The results of that will be fed into new mine schedules, and we'll update our feasibility study. As I mentioned, we expect a significant increase in the overall scale of the project, an extension of the mine life, and that will allow us to finalize offtake agreements and wrap up the funding. So there's a strong flow of news items coming forward just on the Spanish project. And in Canada, we'll have a program in the Yukon progressing later this year, and we'll also be announcing about our drilling plans for the Midrim high-grade nickel copper project in northern Quebec.
So Nanolos is a biomaterials company developing a sustainable form of cellulose made from waste. Many people may not have heard of cellulose, but we use it every day in a range of products, mainly things like paper, textiles and clothing, and also absorbency products. But you can also find cellulose in a diverse range of products like car tyres and tea bags. It's a remarkably versatile material. The only downside to cellulose really is that it currently comes from trees via the wood pulping process. There are lots of applications for cellulose. Nanolos is focusing on the textile and fashion industry. And the reason for that is because it's a very large market, it's a growing market, it's a margin with high margin elasticity, and a very low barrier to entry. Fashion industry has a serious problem with environmental issues and sustainability. It's one of the world's largest polluters, but changing that to a sustainable industry is not as simple as it sounds. If you look at the fibres that the industry has to work with, the main fibre they use, which accounts for 66% of the market, is synthetic fibres, and that includes things like polyester, nylon, acrylic. The problems with that, of course, is that because they're plastic, they're not biodegradable, they cause pollution, they're also made from non-renewable resources like petroleum, and they're fairly energy intensive in the process. Cotton is the second most common fibre in the industry, and that accounts for 27% of the market. Cotton is a lovely, natural, organic fibre, decomposes, it's biodegradable. The issue with cotton, I guess, from an environmental point of view, is that it requires an awful lot of land, water, pesticide, and the production of cotton is fairly limited and not expected to meet the increasing demand. The third fibre in the industry is rayon, which accounts for about 6% of the market. And that equates to about 21 billion US by 2024. And that's the area that Nanolos is playing in. We're making rayon. The only downside really of rayon is that it currently comes from wood pulping of trees. Other than that, it's a very well accepted fibre, it's biodegradable, it's natural, and it's the area we're playing in. So currently though, over 200 million trees each year are chopped down to make rayon. So that's the only downside really of rayon. And we have a solution for that, we think. Sustainability is all the rage at the moment. When we first started this project quite a few years ago, a lot of people thought sustainability was just a short-term greeny fad and that it would go away. Well, that's clearly not the case. It's here to stay. It's getting more and more mainstream. A lot of people thought that with the advent of COVID, that would derail the whole sustainability movement, but that's turned out not to be the case. If anything, the COVID has just highlighted to a lot of consumers that man's impact on the environment is causing problems. They've associated COVID with impact on the environment, and sustainability has just become more and more of an issue. I don't think there's a single fashion brand out there that doesn't have some sort of sustainability initiative associated with it. So what's our process and why do we have an advantage? Well, if you look at the current process for making rayon, you take trees, you chip those trees, and then you have to pulp those trees in a very energy intensive process called wood pulping. And the reason for that is a tree is only about 40% cellulose. The rest of it is lignans and other impurities. That cellulose then is converted into rayon fibre. The process that Nanolos has is we don't use trees, we actually take waste. We take organic waste from the food and agricultural industries. We ferment it with a natural bacteria, and that produces cellulose. It produces pure cellulose, so we don't have to do the wood pulping process. So that saves a lot of energy and time. It produces tree-free cellulose, which we then convert into rayon fibre. So we don't have to chop down trees, we don't have to do wood pulping, and we're using a waste. So the investment highlights, we believe we have a superior technology, doesn't require trees, doesn't require wood pulping, and we've already made a garment proving the technology works on a lab scale. We're in the pilot phase now. High growth markets, 21 billion US for the rayon market alone. Other markets are available to us as well. We have a strategic partnership with one of the world's biggest fibre makers in Grasm. They have 24% of the rayon market by themselves. The shift is happening. People are moving towards sustainability, no doubt about it. And we've got significant opportunities outside of the fashion sector as well.
Hi everyone, my name is Tia Angelos and I am the founder of Smart Women Society. We are an online education platform that helps our amazing community of women to get smarter with their money, their career, their well-being and their love lives. Today I'm here to talk all about investing, and investing is quite a trendy topic at the moment, and you've probably seen it everywhere all over your social media, especially with the growing popularity of cryptocurrency. But investing can be incredibly overwhelming and daunting, especially for first-time investors. Today, I'm going to chat to you about 5 things that you need to do before you start investing. Let's get into it. So the first thing that you need to do is to build an emergency fund. This is so important because unexpected emergencies in your life are inevitable. It's just part of life, but you need to make sure that you're prepared for them. The first thing is to keep your emergency fund in a high interest savings account so it's always easily accessible if an emergency does arise. It's best to start with $1,000 to get you started and then aim for 3 to 6 months of your living expenses. Emergency funds are so crucial, I cannot emphasize that enough. Number 2 is to know your cash flow. This is super important and a lot of people still aren't doing it before they jump straight into investing in the stock market. The first step is to create a budget. So figure out how much money is coming in every month from your income, any side hustles, any other income that you make, and everything that's going out, all your expenses, all your social spending, your discretionary spending, and start understanding the cash flow of your month to month. Then it is super important to track your spending and know what you're actually spending every month. Things add up really quickly, so if you don't track them and get on top of them, things can really blow out. So it's really important to understand your cash flow, really know where it's all going every month, and then understanding how much surplus funds or how much surplus money do I have every month to invest. This is really going to guide you as you start your investment journey instead of just blindly throwing money into shares or into other investments every month. Number 3 is to pay off high interest debt. So if you have any high interest debt, such as credit cards or personal loans, and these could have interest rates up to 20% or more, focus on paying these down first. You are not going to get this return in the share market, especially in the short term. So it's really important that you focus on paying down these high interest debts before you start investing. This is going to rapidly improve your net worth and your monthly cash flow. Number 4 is to define your financial goals. And this one's really important. And you need to sit down with a pen and paper or your computer or something that you're comfortable with and really nut out what your financial goals are for the short, medium, and long term. So think about what you're hoping to achieve in the next 1 year, 5 years, 10 years, and more. Do you want to travel? Do you want to buy a house? Do you want to get married and have a wedding? These are all things that you need to consider. Investing is incredibly volatile and it is a long-term game. So if you are hoping to buy a house in the next year or 2 or have a wedding in the next few years, you need to be keeping some of that money into your savings account so it's readily accessible, as opposed to investing it in the stock market. And lastly, number 5, this one is so misunderstood and misfollowed by a lot of people. Take some time to understand the basics of investing. These are just some of the topics, but there's so many topics that you should research and learn about, because becoming an informed investor is going to benefit you in so many ways. So take some time. There's heaps of resources. YouTube is a great place to start. Books, podcasts, just Googling, and learn about risk, your risk appetite, your risk tolerance, what risk is, volatility and understanding the highs and the lows in the market and what those mean, diversification, why it's important to diversify your portfolio instead of just focusing on one type of stock or investment, types of investments and different portfolios that you can create with them, and also different investing platforms. Which one is going to suit your needs the best, and which ones do you want to actually execute your trades on? So it's really important to take some time, do your research, and understand the basics before you actually start investing. So they're the top 5 things that you need to do before you start investing. And if you want more money and investing content, check us out on Instagram. Hope you enjoyed.
So can you start by introducing who you are, where you share content, and what you like to share?
Hi there, my name's Alex, and I run an Instagram and personal finance TikTok with the same handle @BrokeGirlWealth.
And can you tell me more about the content you share and where you find inspiration for sharing?
I started my Instagram with the hope that I could provide a little bit more of that clarity that I felt like I was missing when I first started investing. I think a lot of the time, the reason people put off investing is because it seems confusing, it seems complicated. You hear all these myths like it's gambling or it's only for rich old men, and you kind of just tune out. And I was the same. And I hoped to make my Instagram, first of all, a little bit of a safe place to ask, the dumb questions. And I don't think any question is dumb, because if you don't know, you don't know. And hopefully be a little bit of the light in a dark room for my followers. And the content I share is, first of all, in a channel that we use. So Instagram and TikTok are places that young people are on. And the aim is to be hopefully a little bit funny, but make these kind of concepts that are really important to understand when you first start investing a little bit easier. And then you can then go on with that little bit of empowerment, that little bit of support to research on your own, understand what you're doing, and then pick the right investment products for you, or even know where to get help, because that's often a really difficult question that we don't often get answers to. Like, okay, do your own research. Where do I go and get that research from?
And could you tell me really, why do you believe investing is critical to beating inflation? And what are the compounding benefits?
So we often hear about, inflation rates are blah, or the consumer price index is doing something. And I know for me, I just tuned out because I didn't get it. I didn't really understand how it was so important to my life, or if it even had any relevance to my life. But you begin to realize that inflation is just the increase in cost of things that you purchase every day, whether that's your milk or your car insurance. Inflation is a measure of how much did it cost yesterday and how much does it cost today. And the reason that's so important is because your money needs to be out earning inflation in order for you to have more money this year, in order to continue funding all those things that have gone up in price. Now, for a lot of us, it's not something we think about, but over the last 10 years, for example, a grocery shopping trolley full of $100 worth of groceries in 2010 is $120.81. I did look it up before this meeting. So that's almost a 21% increase. So everything's gone up by, on average, 21% in that time. And if you think about, your salary, where a lot of us are just entering the professional market, we are seeing those larger salary increases. But as you get older, those salary increases tend to sort of level out and they get a lot smaller. And at the same time, keeping money in your bank account might only be earning you 0.5, if you're lucky, % interest. So if the consumer price index, which is just how much of things increased, is 1.1%, if your bank account isn't beating 1.1%, then in real terms, your money is worth 1.1% less, minus any interest you get to sort of offset that. So you can actually purchase 1.1% less this year than you could last year, which is kind of a weird thought, because you just think money, well, there's $1,000 in there last year, there's $1,000 in there today, but the purchasing power has changed. And so when you start to unpack this, you realize that for long-term wealth in order to offset the impact of inflation. That's why people invest, because they want to make sure that their money is able to purchase the same amount today as it is tomorrow. And why is investing this magical thing? Well, your investments can compound. So today, let's say you invest $500 and then you invest that amount every month for the next 10 years, let's say. Investing takes an investment amount of around about 60,000. So that's how much you would have if you had it in your bank account, plus any interest you might accrue. And over 10 years, you would have earned around about $32,000 just in your investments compounding. So in total over that 10-year period, you'd have $92,000, of which only 2/3 was money you put in. The rest is just interest rates doing their magic, and the power of an investment sitting in an investment account for a long period of time and actually having the time to compound. And that's really it. You just want to try and beat inflation. It's the name of the game.
Hello, everyone. My name is Matt McNamara. I'm the Chief Investment Officer of the Horizon 3 Biotech Fund, which is a $100 million later stage venture capital evergreen fund aiming to deliver at least 20% IRR net to investors. We are an experienced group of biotech investment executives with the purpose of improving lives globally. To qualify as an attractive investment prospect, portfolio companies need to be relevant to the markets in North America, Europe, and Asia. The technology cannot be a fast follower or a me too product. It needs to be leading edge technology delivering a breakthrough biotechnology. And the important notice highlighting this fund is for sophisticated investors only. Our team's definition of biotech is the cutting edge of human healthcare products, drugs, devices, diagnostics, and digital products, not service companies like hospitals, pathology, or aged care. Our investment strategy is to be high conviction, active investors, typically on the boards of our portfolio companies with global deal flow from our internationally networked team. Normally, biotech investing is long-term and very risky. We will invest in a diversified group of 10 later stage companies that after a thorough due diligence process, we are confident can deliver a 1x return per annum of our investment over a 3 to 5 year period. Our differentiated approach to biotech investing can be summarized as follows. Firstly, we reduce the risk in biotech investing by avoiding early stage startups and selecting companies with development runs on the board. Traditional biotech VC investing takes up to 10 years to reach an exit. Later stage biotech investing is more akin to PE. We call it growth equity investing, where we only invest in companies that have progressed significantly. Secondly, we reduce the risk in biotech investing by only choosing investments that have 1 or 2 milestones to achieve in a 1 to 3 year timeframe. That will then be attractive acquisitions for a trade sale and or exit for the fund. The reduced number of milestones required to attract an exit reduces the timeframe the investment is held and is designed to give investors liquidity events via exits on a rolling 3 to 5 year basis. Thirdly, by investing in later stage companies, public or private, we increase the number of successful portfolio investments compared with traditional venture capital investing. These graphs represent my more than 20 years of biotech VC investing. Traditional early stage investing typically results in about 1 good success per fund over a longer period of time, whereas the later stage investment strategy typically results in a handful of successful portfolio companies and thus represents a lower risk, diversified portfolio that will more consistently deliver greater than 20% IRRs net to investors. So if you or your clients are looking to participate in biotech investing with an experienced biotech investment team and contribute to improving the lives of people globally, we invite you to choose a de-risked later stage strategy. Spread your success across a portfolio of 10 public and private companies that will reach valuation inflection points quicker than traditional VC investments. The Horizon 3 biotech team has a broad cross-section of skills required for successful biotech investing, including funds management, investment analysis, drug evaluation, clinical trials expertise, business development, and commercialization expertise. My track record over the last 15 years of managing industry superannuation, government, and high net worth monies has been 22%, 24%, and 44% IRRs net to investors. This fund offers sophisticated investors an efficient way to get a meaningful portfolio exposure to biotech, potentially greater than 20% IRRs, and have a positive impact on global healthcare. We also provide access to DD capability and high quality deal flow that typically investors cannot get elsewhere. We have 3 investments already in the portfolio. I look forward to hearing from those that would like to know more. Just go to the website and book a meeting as per the QR code. Thank you for your interest.
Hi, I'm Bill Guy, Chairman of Theta Gold Mine. In the last 3 years, we've doubled our resource base to 6 million ounces. We've entered the top 100 ASX companies by market capitalization. And this quarter, we've completed our first free mine study of our underground resources. You can see the some of the economics there on the front page. There's our disclaimer. We're the 3rd largest resource on the ASX, not controlled by a major. We have great discovery costs. Because we have 150 years of data, we can drill and build our resource out very cheaply. We offer great value to the investor in terms of our peers. We're going to be a low cost miner. We've got a board and management that built over 20 projects, and we have a lot of flexibility with over 43 mine sites under management. In terms of our peers, we compare very well. You can see there we've got 45 million tonnes, a good grade of 4.17 grams, and offer a great EV valuation to the investor. We've got a market cap of over 100 million Aussie dollars. There's 503 million shares on issue. Top 10 own 68%, so it's quite tight. We're 370 k's northeast of Johannesburg. South Africa produces 40% of the world's gold, so it's some of the best geology in the world. It's an excellent jurisdiction. It's a mining jurisdiction. It's a democratic society with English law. It has large gold fields, and it's a near-term production story. We've got a very low capex of around 40 million US, and you can see on the top picture there the historical mine site. In terms of ESG, South Africa is very strong. It has a thing called the Mining Charter Free. So your ESG requirements are basically legislated by the government, and you have to comply with those rules. We've got a strong environmental program going. We've completed numerous studies. We know if we remove all the invasive species from our land, the mine will actually have a positive benefit on the water content going forward. So we'll actually put more water back in the environment than we take away. Got a very strong social commitment with direct ownership of over 26% there in South Africa. We have historical disadvantage in our corporate and on the ground working for us. So we really look after the community there. And we're an ASX-listed company, so we're quite transparent. Just in terms of where we are, we've completed our first free mine study. We know with free mining units, we get 60,000 ounces into the future. We want to grow to 160,000 ounces a year. So we know we need 7 mining units to do that. And we know if we can do all these tasks, we'll positively benefit over 20,000 people in the local area, which is quite depressed. That slide just shows you the different mining units. They cost about $10 million each. Just in terms of the PFS, we've got an 8-year mine life. We've got a very short payback period of 13 months. Got a net present value about 91 million, a low capex project of about 37 million. And that's on a 1570 US gold price. So at Theta, we're always very conservative. We've sit in the bottom quartile for cost in South Africa. But this is really the big one. In terms of discovery cost, we discover our gold for less than 12 US dollars an ounce. We're transitioning to production status late 2022. We got an all-in sustaining cost there of the gold, less than half the gold price of 900. It's a multi-million ounce, and it's a multi-million ounce gold field, and a very strong ESG there in South Africa. So Theta is very supportive of the local community and the investor. I hope you enjoyed today's presentation. Check us out on the website. Thanks very much.
Patricia, the Executive GM of Renewable Technologies. Our ticker code is WOO. We're a SaaS provider operating in the space of employee engagement, recognition and reward. I'm part of a passionate team with a vision to lead the market in the improvement of mental health and wellness in the workplace. With backgrounds in health, sales and marketing, our team is building relationships with human resources executives at major corporations to encourage them to bring mental health to the forefront of their employee engagement strategies. WooBoard is a cloud-based engagement platform that helps companies build culture around daily mental health support and peer-to-peer recognition to help employees feel more valued, appreciated and cared for, resulting in increased workplace wellness and performance. Think of us like a mind gym for your team. The employee engagement market is saturated with rewards platforms that work on the premise that those employees who do a good job receive recognition or reward for their efforts. And a recent HubSpot survey shows that 69% of employees say they'd work harder if they were better appreciated. But that's really only one part of the equation. The challenge we've identified at Woo is that to do a good job, an employee must first be mentally fit. So a program that recognises those employees who are already highly productive is not really addressing the underlying cause of poor productivity, and therefore not creating an inclusive culture from which to recognise and reward fairly. WooBoard offers two distinct dashboards. The Wellness Dashboard tackles workplace mental wellness head-on with automated confidential employee wellness check-ins and mindfulness activities and content that improve an individual's well-being in the moment, leaving them calmer, more focused and better prepared to continue their day productively and positively. The Rewards Dashboard facilitates a simple way for managers and colleagues to quickly show appreciation for the work of a team member by sending them a woo, sharing progress and wins, earning points, and delivering rewards for ongoing performance. At WooBoard Technologies, we have a hybrid working environment for all team members and use WooBoard internally to ensure employee wellness. We also have various team building events. Our hiring policy and gender diversity policy ensure all qualified applicants will receive consideration for employment without regard to any discriminatory factors. We are strict on governance and policies, including a code of conduct to deal with matters such as conflict of interest, confidentiality, health and safety, and bullying and harassment. We also have a disclosure and communications policy, GDPR, compliance and security privacy policies as well. Our pricing structure is a volume tiered model that enables any size of company to participate. Companies commit to a minimum 12-month contract to pay a per user per month fee of between $3 to $5 Australian dollars, depending on user volume. Companies that commit to longer contract periods are rewarded with additional rebates. So to enhance an employee's mental health and productivity of one valuable person in the organisation costs no more than $60 per year. We have also recently signed a milestone 3-year agreement with Philippines Air Asia Incorporated, which commits Air Asia to 1,550 licenses with more to sign over the term of the agreement. We're currently working on a number of updates to the platform, including additional interactive dashboards, referral programs, and charity alignments. We're driven every day by our brand promise to unlock the unity, productivity, and fun that comes when people are focused, engaged, and rewarded. If you're part of a company that needs to put mental health at the forefront of employee engagement, please get in touch.
Good day. My name is Bob Prue, CEO of Imagine Biosystems. It's my pleasure to present IBX, our company, to the Capital Networks today. Imagine Biosystems is an Australian medical device company developing new medical imaging agents using magnetic nanoparticles. You know, today we spend about $60 billion globally using existing medical imaging methods, such as X-ray, CT, or MRI, that can identify a region of interest, but cannot differentiate benign lesions from true cancers. Our technology focuses on using our biosafe nanoparticles to specifically detect the presence of a tumor. This shift to functional or molecular imaging has the potential to be more sensitive and more specific than current methods, and with that, reduce healthcare costs, and improve outcomes by being able to detect and treat cancer much earlier. There are multiple commercial opportunities for our technology, and our first product for the staging of metastatic breast cancer has been designated by the FDA as a breakthrough device. Our first MagSense imaging agent is currently in phase 1 clinical testing in Australia, where we've already begun enrolling patients. And while our first product is focused on breast cancer, it's important for investors to know that we aren't a one-trick pony. The underlying magnetic nanoparticle technology has broad applicability in diagnosing and treating diseases. And our goal is to develop a strong pipeline of MagSense imaging agents to improve how cancer is diagnosed. Just think about it. Each year, more than 1 million men in the US alone have prostate biopsies, with many having no disease. Even worse, the diagnosis of ovarian cancer is often at late stage because the current imaging method by transvaginal ultrasound, they are not sensitive enough to catch it early when it's most treatable. We believe our MagSense technology can be applied to many of these solid tumors within the existing diagnosis and staging protocols and have a significant impact on patient outcomes. We expect to commercialize the technology using strategic partnerships with one or more of the existing players in the medical imaging space. And in addition, we're working with third parties that would generate revenues for IBX through their use of our nanoparticles for various therapies. From an ESG perspective, the obvious headline for IBX is the potential societal impact we can deliver from the reduced disease burden and reduced healthcare costs. By enabling the earlier detection of cancer, we can have a tremendous impact on healthcare. I'm also very proud of the foundation we've built to support the future of the company. We have a very strong board with deep experience in the healthcare space and governance of publicly listed companies. And I think investors can be proud of being stakeholders in IBX, and we'd welcome the opportunity for new investors to join our registry.
So what are your immediate priorities or catalysts as a company?
Yeah, so our immediate focus is this phase 1 clinical study that we're doing in Australia. So this will be sort of the initial proof of principle, if you will, that our MagSense imaging agents can actually work. So we're very focused on completing that phase 1 study. It's about 15 patients that we expect to be done by around the end of this year. And from that will then drive the next development timeline of actually getting into a full-blown pivotal study. In the meantime, we're working on early stage preclinical work in prostate cancer, ovarian, and brain cancer so that we can have a pipeline so that when we go to a strategic partner, it's not just the breast cancer test, but we'll have a portfolio of products that we know that they can help us commercialize.
And how would you like to be positioned this time next year?
So this time next year, I think we would really like to have this phase 1 study completed with good understanding of what those clinical data tell us about the future development of the product. From there, we'll still have some more work to do in order to actually get into a full clinical study. But I think at this time next year, we should be well on track to advance that HER2 product, the breast cancer product, actually towards commercialization through a pivotal study, and should have a portfolio of products that are coming up through the preclinical pipeline.
Finally, how are you positioned from a capital perspective, and why are you excited for the company's future?
Yeah, so today we've got about $13 million Australian in the bank. So we're pretty well funded right now. That's sufficient capital for us to get through this phase 1 study and get us started into next year. Obviously, we're looking at the phase 1 study data to be an inflection point for the company. And then we'll use that to fund the further development for the company. But we're very optimistic. The phase 1 study is on track right now. And we believe we're in a good position to get through this study and then be ready for next year.
Hi guys, my name is Anna, aka Panda Boss, and I'm a 29-year-old finance professional who started investing about 18 months ago, and alongside that I started a YouTube channel all about personal finance and beginners investing. What I wanted to do today is just give you a few quick tips if you are considering getting into the world of investing, to help you learn from some of the mistakes I made, but also from what I've spent the last 18 months learning. If you want any more detail and just want generally more information about beginners investing, then make sure to check out my YouTube channel. It's called Panda Boss Personal Finance. So without further ado, let's just jump straight in. The first thing I would say is don't be scared of investing. So many people I talk to see it as this complex thing where it's so risky and they're so likely to lose their money. But it completely depends on your risk profile and what you invest in. The majority of people I speak to don't even realize that their pensions are actually invested in the stock market. Even if you invest in extremely low risk investments like ETFs, you are likely to outperform inflation and the amounts you can get in your savings accounts. So essentially what I'm trying to say is just get started as soon as you can. My next tip would be don't just invest all of your money. Once you start seeing your money grow, it can become very addictive to just chuck everything at the stock market. Whilst this is great whilst your investments are going up, there will be times when they go down, and if you need access to that cash, you do not want to have to be pushed into withdrawing your money at a loss. So the best thing to do is to make sure that you have an emergency fund saved up way before you start investing. What I did personally when I was on my journey, I would chuck some of my money into investing, some of it into an emergency fund, just to make sure that both were building up. My third tip would be to diversify your investments. Now you can easily do this by investing in ETFs, but the general thing that I've noticed is that whilst one sector is doing badly, another might be doing very well. So what you don't want to do is just put all of your eggs into one sector and then everything sort of crash and then you panic. And that leads me on to my next tip. Don't panic sell. There are so many people that I know who see their shares going down and then sell in a panic because they're trying to minimize their losses. But unless there is a fundamental reason for these shares crashing, which may well be the case, but unless there is a reason for you to believe that that company is going to go bust, just leave it be. The stock market goes up and down all the time. The last thing I want to talk about is don't fall for get rich quick schemes. If someone is promising you quick guaranteed returns, it's probably too good to be true. Nothing is guaranteed in the stock market, especially short-term gains. So make sure you are sensible with your investments. Make sure you do your research. Make sure you speak to people who know about this. Seek out financial advisors if you need to, or just learn about it yourself through books and articles and YouTube videos. But just make sure you are comfortable with what you're investing in and don't take on too much risk, especially as a beginner. Those are essentially my top tips, so hopefully that's been helpful and best of luck. Bye.
My name is Yuri Wessels. I'm the Executive Chairman of Arcadia Minerals. We listed last week Friday on the 25th on the ticker AM7 on the ASX. We are an exploration company that are focused on battery metals. Battery metals is very important for the new age where renewable energy is the method of producing and supplying the energy and the power that we need for the new age. And that's where we play or intend to play a large role. The directors of the company are people that have experience in exploration and putting projects into operation and then putting them into production. Our focus is in Namibia. We have a number of projects there. We have a tantalum project, which is also a so-called new age element that is being used in electronics. The cell phones that people hold every day, that contains quite a bit of tantalum, and so do the laptops and everything else that goes with it. So, and then secondly, we have a nickel project. Nickel is the foremost method of storing or using the storage for energy or electricity in electric vehicles. It's part of the, it makes up about 70% of a electric vehicle battery. And that is also, for that reason, a very important element in the renewable energy space. Then we have a project additional project in lithium in Namibia. Lithium is on everybody's lips as well. That's also very important in the renewable energy space, especially with electric vehicles. Then lastly, we have a copper and a gold project. Copper, of course, all these electric vehicles will be using a lot of copper. The Swanson project, which is our tantalum project, we believe that will be underpinning our value in the sense that once the company has developed that project and it is in production, then that will underpin the value and exploration of the exploration basis of this company in two ways. Firstly, usually exploration is a industry where it carries a lot of risk, and if the project fails, then the company fails. In this instance, we believe that the tantalum project and the widespread of projects that we have would prevent that failing of occurring. And then secondly, a second element to exploration is it needs cash. It doesn't generate cash initially. And if you have a mining operation like we do, we hope to have, we think that will happen, then that cash would be then supplied to continue exploration and thereby reduce the chances of dilution of shareholder value. I'm not going to take too much time on taking you through the projects on a technical basis, but that is our Swanson project. It's got high grades in the resource. It's easily mineable. This is the nickel project where we expect to make hope to make a major discovery of a massive sulfide, magmatic hosted nickel sulfide deposit. That is what everybody would be aiming for if they are looking for nickel. And the gold project, we have a 20-kilometer strike area with some really interesting results that we've achieved in that area. That license area lies next to existing mines, is clearly in a space where there are other mining companies in existence, and we could call it that we're in elephant territory. The lithium project is a brines deposit, and that contains a section where we expect to find lithium and then maybe make a new discovery of a lithium brines deposit, which is unknown in Africa at this stage. Our ESG credentials relating to our environmental side of things is that, of course, as I explained, we are exploring for battery metals. We also would be looking at a ESG smelting technology in ESG on the basis that it would be carbon efficient and maybe produce also some hydrogen. Socially, we would be focusing on skills transfers in the community, and then on the corporate governance side of things, we have adopted a corporate governance policy that would be commensurate with the size of the company. Thank you.
My name is Nick Pollock and I'm the Chief Commercial Officer for K2Fly. K2Fly is a listed software business on the ASX, and I'm the Chief Commercial Officer of K2Fly. I'm in charge of organic and inorganic growth and the company's strategy. As a business, we're passionate about delivering sustainable outcomes for our clients, communities, and the environments in which they operate. I myself have been in the mining industry for 15 years and joined K2Fly because of a love of the industry, but also a passion for sustainability. I've done 2 postgrads in that regard, one from NYU in sustainability, and last year I completed my postgrad in sustainability leadership from Cambridge University, which was focused on the mining industry and sustainability. This brings us to some core beliefs that K2Fly believe in. If it's not grown, it's mined is an old statement that's been around for a long time. But if we really want to be a truly sustainable world, and under the current paradigm, it's essential that we have mining in order to produce the copper, the aluminium, the steel, the lithium, to build wind turbines, to build electric engines, and to build mobile phones. That said, it's important that we're not apologists for the mining industry and its negative impacts on the environment and communities that we've seen in the past. K2Fly's role is to deliver those solutions that make the industries in which we play more transparent and accountable to all stakeholders, that is the communities they operate in, the regulators and investors, of course. In terms of our business, we are a software as a service business, and therefore we focus on today asset intensive businesses, which today is mostly the resources industry, which does need considerable help in this area. So we provide software that delivers operationalized environmental, social and governance outcomes. As an investment proposition, we have the recurring revenue model that a software as a service business brings, and that's been growing rapidly over the last couple of years at an exponential rate. We have significant industry endorsement from partners such as SAP, Esri, which is geospatial leader in the world, and increasingly Microsoft. Finally, in terms of our solutions, if we start on the left-hand side, we deliver resource inventory reporting. That is how a mining company reports its mineral inventory, its inventory in the ground, to its shareholders and investors. That goes into their annual report. It's incredibly important and highly governed piece of software that we deliver. So that is a great sort of traditional value driver of a mining company. What is my inventory of ore or ounces of gold times prevailing price of the day? Increasingly though, if we go to the right-hand side there in community and heritage, we can see, and you will be aware of recent disasters, if you like, that have occurred in the industry where there was destruction of ancient cultural heritage sites in the Pilbara of Western Australia, known as the Juukan Caves. For instance, K2Fly now delivers the software that we are building with Rio Tinto in order to ensure that that never happens again. So we are working with Rio Tinto to deliver the best outcome in protection of community heritage going forward. So that's a really good example of the traditional valuation of what inventory you have in the ground versus community expectations and the value creation or destruction that a negative action can cause to a mining company and its reputational value as well as its financial value. We also work in other key areas in the industry like dams and tailings. Some of you may be aware of the disasters that happened in Brazil in the last few years with tragic loss of life. So again, we build software to help companies manage and disclose pieces of information to their investors, to their communities, in order to ensure that those sorts of things never happen again. Rehabilitation and closure is always an important part, as well as access. Importantly, with a lot of these things, particularly the community and heritage, we work with not only with mining companies, but our next biggest group of customers would be traditional landowners. So we work closely with the traditional landowners with the same software to deliver protection of community heritage and also to hold the mining companies operating on their lands to account. So we feel that we provide a very balanced service to the mining industry, to the community, and particularly for the communities which operate and the traditional owners. Thanks very much.
Thank you for joining us for MarketLit, Australia's first Millennial, Gen Z and Financial Influencers Investment Conference. I'm Lelda Smits from the Capital Network, and we are proudly Australia's premier investor and media relations consultancy. If you like what you saw at MarketLit, please be sure to like and share the video, subscribe to TCN TV and TCN, and drop us a comment. Tell us who you would like to hear more from or be connected with, or if you're an investor, send us an email so we can keep you in the loop with the latest ideas to empower. To keep updated with all our developments, follow or subscribe to our social media channels or send us an email at info@thecapitalnetwork.com.au to start a conversation. For now, thanking our presenters, contributors, team, and importantly, audience. We value this community and want to see it thrive and wish you all the very best in your investment journey.